City, I'm Shauna Smith alongside Brad Smith. This is Yahoo Finance's flagship show, The Morning Brief, the ultimate guide to help investors make smarter decisions for their portfolio. We're tracking early session volume while bringing you today's top market themes and elevating Yahoo Finance's most popular newsletter.
That's right. We've got an action-packed show for you on this Wednesday morning. My goodness, how have we gotten here so quickly? Yes. Today's trading session. The theme? Scattered earnings. We're about halfway through the earnings season, and it's shaping up to be a mixed picture. About 2/3 of S&P 500 company reports now in, and we're going to break down the areas that weakness has emerged the most.
And investors parsing through a new batch of earnings here this morning, and after the bell last night, we heard from Uber, Alibaba, Young, Snap, among the top trending tickers on Yahoo Finance. So let's get right to it with the three things that you need to know, your roadmap for the trading day. Yahoo Finance's Pras Subramanian, Dan Halley, and Josh Lipton have more.
Hey, Sean. Yeah, so Ford shares moving to the upside in pre-market trading after the automaker reported quarterly sales that topped Wall Street expectations and projected an upbeat full-year profit outlook powered by its Ford Blue ICE business and Ford Pro commercial unit. Now, its EV business is projected to lose over $5 billion this year, with Ford claiming it won't see profits until its Gen 2 products come out.
And Snap stock getting rolled, plummeting more than 30% in extended trading after the social media company's revenue came in lighter than the street expected and offered weaker guidance. The news overshadowed Snap's positives in the results. Daily active users rose 10% to 414 million from a year earlier. But Snap continues to struggle over the slowdown in digital advertising, trying to keep up with heavyweights like Meta and Alphabet.
And regional bank turmoil grows. New York Community Bank Corp appointing Alessandro Danello as the new executive chairman this morning. The leadership changeup coming as the regional lender gets cut to junk at Moody's. Moody's warned growing troubles at NYCB could continue to fuel lower ratings for the regional bank as it deals with, quote, multifaceted financial risks and governance challenges. The stock hitting its lowest level in more than 20 years after posting a surprise net loss in its fourth quarter earnings.
Well, Snap shares plunging in pre-market trading after missing on revenue, reporting slower user growth. The top trending ticker on Yahoo Finance, look at that, it moved down about 31% ahead of the open. Now, the company continuing to struggle to turn around its ad business, a totally different report than what we got compared to one of its rivals out there, Meta. So let's talk about the reaction that we're seeing play out in the stock right now and what it looks like for the company going forward. We have James Heaney. He's Jefferies Vice President of Equity Research. James, it's good to have you here. So disappointing report clearly here from Snap. You're seeing that reflected in the move to the downside ahead of the open. A loss that we're seeing here, is that justified?
Look, I mean, the quarter was definitely a lot worse than what people were expecting. I mean, 5% year-on-year revenue growth was more or less in line with the 2 to 6% internal forecast that they provided, but it was, well below the buy-side bogey of, roughly 10% year-on-year growth that people were looking for. And look, this was a super crowded long into the print. I mean, if you look at the stock action, the stock had almost doubled since the last print. So it really needed to be perfect. And, it was far from that. So, I think there's a justified move down, but we still like the stock and think it can recover on the acceleration that we're expecting into Q1. So happy to dive in more. But yeah, gut reaction. The move makes sense, but we still think, there's a buying opportunity here.
They summed up 2023 as a pivotal year for Snap, as they said on the call. And now for 2024, they're saying that there are three things that they're really going to focus in on. Machine learning models for more ad interactions across the platform. Second, the content experience across Spotlight and Stories. And then lastly, shifting more of that focus towards user growth and deepening engagement on their monetizable geographies. What do you believe is going to be the necessary catalyst for them to hit all of these main pillars in stride over the course of this year, and how investors should be grading them along the way?
Yeah, I think what's most important is just to continue to monitor what the advertisers are seeing, right? And ultimately, we started to hear inklings that Q4, performance was starting to improve for advertisers, and it hasn't showed up yet in results because there's often a lag. But we do think that they've been putting in the right investments. I mean, they've shifted the ad model to be more of a performance-driven ad platform. So, what we would continue to monitor is just the advertiser traction with these kind of more click-through based ads. And ultimately, we think that's what's going to drive better performance for advertisers and then ultimately higher budgets. And we are seeing that start to happen with Q1. They're already guiding to roughly a 10 percentage point acceleration as we go into the first quarter. So that's encouraging. And then as it relates to the user growth, yeah, we actually think unifying, the Spotlight and Discover tabs into a unified content platform makes sense, right? Like if you go onto Meta and you're scrolling, right, it's all within one feed. You don't have to navigate to a bunch of different tabs, which, on Snap, there's 5 different tabs. So it's actually not the best user experience. So we think if they can improve the engagement, that's going to make the platform more attractive to users. And obviously that will have ripple effects through to the advertisers as well.
James, how confident are you that they can improve that user engagement, that they can implement some of those changes that you're outlining?
Yeah, I mean, look, they have I would say a mixed track record. Obviously, they've had, turnarounds that have been very successful, right? If you went back, call it 5 years ago, there was this Android app fiasco and they were able to rebuild that app and, then it became a lot more attractive to users and advertisers came back. So I actually think this is one that they can pull off. It makes a lot of sense that you want all the content to be in one unified place for people to view. I think having Discover and Spotlight in separate tabs is not really intuitive. And if you think about what Meta did, when Reels first launched, it was basically its own tab. But now you pretty much see all feed and Reels all more or less within one unified experience. And that's just better for the users. So I think they can pull it off. I think they're going to do a lot of testing. There's always risk that it's disruptive and people don't like change. But I think over the long term, it's the right thing for them to do and should overall increase user engagement going forward.
James, after this earnings report, Snap is about to open up in the market at $12 a share, $5 below where it went public. Once again, we're seeing some of the price action be an issue for Snap post earnings here. For an investor that is listening to your bullish sentiment here and looking maybe 5-7 years down the line, if Snap is able to get to that point, they're also going to have to navigate through different types of devices that people might be using at that time, whether that's a foldable phone or a foldable tablet or even perhaps a headset, as we've seen our first New York City subway sighting of such a Vision Pro. How is Snap going to ultimately kind of pivot to some of those other devices, and how do they then kind of fare in that environment with new devices that are set to be rolled out?
Yeah, I mean, I think it's a good point, and obviously everyone in the industry is investing a lot behind, augmented reality, virtual reality, mixed reality technologies, and Snap is obviously one of those companies. I mean, they have their own, spectacles devices that is, basically an AR headset for users. That being said, I don't think that, Snap's strongest core competency is in necessarily AR and VR technology, and from a hardware perspective at least. But we ultimately think Snap's platform is going to exist on whatever the next mode of, communication may be. So if people are interacting more on Vision Pros, we could imagine a world in which Snap's technology will be adapted to those devices. And ultimately, it's probably going to be an even more engaging user experience than what we have today. So we don't think they necessarily need to own the hardware to be successful in this next generation of the internet. We think they can be successful no matter what device people are using.
Yeah, no, I don't think they need to do hardware either. I just need to know that it's going to be a synonymous type of experience with what many end users already have right now. James Heaney, who is the Vice President of Equity Research at Jefferies. James, thanks so much for taking the time here with us this morning.
Thank you guys for having me.
Certainly. Well, shifting gears here, regional bank turmoil growing. New York Community Bank appointing Alessandro Danello as the lender's executive chairman this morning. The leadership changeup coming after the regional lender's credit rating was downgraded to junk at Moody's. Last week, the bank posted a surprise net loss in its fourth quarter earnings and slashed its dividend. Shares are trading at their lowest level in more than 20 years here. More on this announcement specifically from New York City Bank. And as we're tracking shares here this morning, which have been seesawing, especially over the past few trading sessions here, in addition to continuing this or this role on the board, Dinello going to be working alongside the current president and CEO to try and improve some of the aspects of the bank's operations. But this does not kind of glide past the fact that you have some core executive roles that apparently had been empty even prior into going into this report as well, or recently, that kind of spells out some of the larger question marks investors still had this week and even prior to that as well.
Yeah, and Brad, they released a presentation here for investors this morning up on their site that's also adding to some of the maybe improved sentiment, if we want to call it that, surrounding New York Community Bank Corp. At least right now, the company saying that their liquidity here, or company deposits have increased since the end of last year. Liquidity remains, quote, ample is the word that they use to describe their position right now. So that's helping to alleviate at least some of the fears that have been surrounding the bank. But again, when you take a look at that longer term chart, the massive drop that we have seen play out and over the last several trading days, with the stock off about 60% following their surprise announcement here, just in terms of their positioning, given the risk of their tied back to the exposure of commercial real estate. So again, this is really just setting some jitters off throughout the market there. People still very familiar with what played out less than a year ago, going back to last March, when we did see the failure of a couple of regional banks, some fear that we could potentially see something similar. Now, still way too early to begin discussing that. But I think when you look at a drop like this of about 60% here over the last several trading days, it really points to the fact that investors are very nervous about the positioning right now. And you're also seeing that reflected in the analyst calls. At least 14 brokerages have either cut their price targets or lowered their ratings on the stock in the last week.
Yeah, it'll be interesting to see how this impacts some of those key metrics, especially deposits. That was a larger headwind for many of the regional banks, and if there will be any further consolidation that takes place, we'll see how New York City Bancorp continues to navigate this environment.
All right, let's take a look at shares of Ford, because they're gaining in pre-market trading, driven by the auto giant's fourth quarter earnings beat and better than expected guidance. Autos reporter Prasad Romanian has been digging through this report for us. And Pras, there was so much focus on Ford's EV strategy going into last night's print. And we did learn a little bit more maybe about what that's shaping up to look like here in the future.
Yeah, we're going to see more losses, steeper losses in 2024 compared to 2023, which I think was maybe a little bit surprising. Maybe people thought we'd see the kind of a same sort of level of investment there. So we're seeing that there. Investors, are actually shaking that off, and they're kind of happy to see that good forecast. But also, they're seeing that Ford talking about second-gen cars, these newer cars that they think will be more profitable out of the gate. Those won't be here till 2025, 2026. So there's some time there for Ford to sort of lay down those investments into the new factories, but also be a bit more judicious in their spending. I think that's also a big thing you heard last night in the call. And what they're going to focus on is larger trucks and SUV EVs, which they say they have a competitive advantage in. They want to focus on that. And then also smaller cars. CEO Jim Farley revealed on the call that they have an internal skunkworks operation where they're building a small platform that they can use for small cars and any number of smaller types of vehicles. And they think that that's where the money's going to be. It's going to be the big cars that they know their clients currently love, and then smaller EVs, which you don't have yet in this country, that are cheaper. The middle ground is just not where they want to play. That's a tough, competitive, really price-driven kind of market, and they say that's not where we can make money.
How quickly do they think those cars, those new vehicles that they're talking about, can come out?
They'd spoken about seeing the new F-150 kind of EV truck in 2025.
Okay.
I think you might see that, and maybe it'll come out in 2026. I think that's sort of realistic, given like how different it might be, software-defined vehicles, things like that. So I think that's what we're talking about. So the next couple of years, there's going to be still more investment, probably still more losses until you kind of turn that tide there.
All right, Pras, appreciate the breakdown. All things Ford. We're tracking shares of F going into the start of today's trading activity. Well, staying in the mobility landscape as well, let's talk a little shares of Uber. They are edging lower pre-market trading despite beating analyst estimates on the top and bottom line in the fourth quarter and reporting a hefty annual profit. The rideshare company saying full-year net income of $1.43 billion in 2023, almost triple what it was a year ago. We've got Tom White, D.A. Davidson, senior research analyst here with us. Tom, great to have you. As you look at this quarter, I mean, some of your notes to us even say, yeah, it wasn't terrible, but I guess the street was looking for more here, and it actually looked like it was quite good on many of the core metrics that we usually look at with Uber.
Yeah, look, I wouldn't say it was terrible at all. I mean, I think it was a clean, broad-based upside kind of quarter. They've delivered a little bit of upside and basically across all the segments on all the line items that you'd want to see. The stock has really been a relative outperformer over the last 6 to 12 months. And so I think, in that situation, you get expectations maybe getting a little ahead of themselves potentially over the last few weeks, kind of heading into the print. And so maybe a few folks might be slightly disappointed that there maybe wasn't a little bit more upside. But, I think the numbers and the guidance, which was also ahead of expectations for the first quarter, just highlight that, this company is really sort of firing on all cylinders. The profit improvement that you touched on is really key. Third consecutive quarter of sequential GAAP operating income improvement. And the runway and kind of addressable markets that these guys are playing in are very large and just keep expanding. When you think about things like new delivery verticals, advertising, both of those I think were big standouts in the quarter.
Yeah, Tom, that's so interesting here. When you take a look at the fact that they do continue to broaden their portfolio of those mobility products, how critical is that in terms of really differentiating Uber, continuing to differentiate itself in terms of those above trend industry growth rates that we have almost become accustomed to when it comes to Uber?
Yeah, in mobility, they continue to try and find new ways to innovate. We think the core UberX product continues to grow at a pretty healthy clip, but things like Reserve, which I myself have been using a lot recently. It's a new use case, that I really wasn't using Uber for in the past. Uber Enterprise in a lot of international markets. There's novel kind of low cost mobility solutions, so like two-wheelers, three-wheelers, taxis. I think all of those things will create, again, a longer runway of solid growth for mobility. And then think about, the fact that this is a multi-product platform and the fact that they're able to stitch that mobility with a lot of the delivery offerings and wrap it through this membership offering, Uber One. We think that, there's just a lot of nice kind of cross synergies across the platform that competitors are going to, particularly its big rideshare competitor here in the US, are going to really struggle to replicate.
Tom, when you look at the tastiest part of this business, Uber Eats, where are you going to be looking for continued kind of investments, either in platform or just in the service that they're offering on that front with some of the merchants that they call out in this report, but also at the same time, there's a lot of mom and pop shops that still need to be able, that they can service their end customer through an Uber Eats?
Yeah, I think delivery for me, some of the trends we saw there in the quarter and some of the commentary, that was the real standout this quarter. They accelerated growth in delivery while expanding margins. That's always a good sign. They've got a lot of different growth vectors there. They can continue to add kind of supply in the core restaurant business. Grocery and retail is obviously a massive potential category. They're already at a $7 billion annualized run rate in gross bookings for that offering. Advertising, that's really where right now the bulk of Uber's nearly $1 billion annualized run rate advertising business is hitting. And is a big driver, I think, of the improvement in profitability of that delivery business. So again, delivery is clearly a pretty competitive category, more fragmented in a lot of ways than rideshare. But we think they've got great momentum there. And again, the fact that they've got this kind of multi-product platform, just creates a lot of cross-selling opportunities that we think really bodes well for these guys continuing to just deliver solid, profitable growth for years to come.
Tom, when it comes to the recession call, obviously no longer consensus, but slowing growth, many forecasters are still anticipating that we will see that play out over the next several quarters. How big of a risk is that to Uber's bottom line?
Yeah, look, I think there's kind of two sort of opposing forces there that I see it. One, I'm a big believer just in the kind of the power of the convenience economy. And, we've seen that once consumers get accustomed to just the ease of being able to pick up their phone and with a couple of taps have delicious hot food, their favorite stuff delivered right to their doorstep, or have a car, just pick them up wherever they are. It's a powerful force, and people, I think it's going to prove a resilient category of spending. That said, I think consumers are going to get more fussy on price. And, that's, I think, a question we field a lot from investors these days. People are pulling up their Uber app. They're, just kind of wow at the price that they see quoted on a lot of their rideshare rides. So I think it's going to be harder for Uber to extract growth from the business by price in this type of environment. But that's why, things like advertising, some of these new lower cost modalities are going to be important, and we think can sustain growth, even if they are slightly less profitable in some cases. Not on the advertising side. That's probably the most profitable thing that Uber can do. But some of these lower cost things are a little bit structurally less profitable. But we think just as this business scales, it's not going to prevent them from being able to continue to expand margins.
Again, Uber shares off just about almost 3% here ahead of the opening bell. Tom White, always great to have you. Thanks so much for joining us here. D.A. Davidson, Senior Research Analyst. All right, well, coming up, Roblox shares skyrocketing after posting record quarterly bookings. We're going to dig into the report and why it matters for your portfolio next.
It's time for some trending tickers here. This morning, we're tracking shares of BABA, Alibaba, after boosting its share buyback program by $25 billion. But the Chinese e-commerce giant did miss revenue estimates in the third quarter as it faces slow economic recovery in the region. There you're seeing shares pre-market. They are down right now by about 4.5%. One of the huge items that I think a lot of investors focusing in on here, especially in this most recent quarter and in the environment that we're continuing to hear come out of China, where consumers are, at the same time as there is more stimulus that is being evaluated to be pumped into the economy, consumers holding on to that a little bit more, not being as willy-nilly to just go out there and spend all the cash. Yeah. But at the end of the day, one huge thing here, they did see growth within Taobao and Tmall, about 2% year over year. GMV, which is that gross merchandise value, that achieved healthy year-over-year growth. They mentioned transacting buyers and order volume also growing strongly, they say, but a decrease in the average order value is something investors might be paying attention to here.
Yeah, it certainly is, and I don't think it's by any really stretch a surprise here when we talk about the weakness that's playing out in the Chinese economy right now. The fact that the recovery has not taken place, at least to the degree that many forecasters had anticipated. You've seen names like Alibaba under pressure as a result, and you were taking a look at a 6-month chart there. Now we're looking at a 1 year, with shares off just about 26%. And when it comes to these numbers that we got out here this morning, the fact that they did announce that buyback program, $25 billion, an increase of $25 billion to its buyback program, it's helping to offset some of the weakness within this report. But again, their core domestic e-commerce business, that missed expectations. Also, the cloud business talking about how they are reworking and restructuring parts of that division in order to focus on more of their higher margin-based contracts there, which would potentially help results going forward. But again, Alibaba under a bit of pressure here this morning. All right, let's take a look at Roblox because shares are getting a big boost off the back of results. And now the quarterly bookings hitting a record high of 1.1 billion, average daily active users jumping 22% from a year ago. And that bookings number there, over $1 billion, that was a milestone that Roblox reached this quarter, up pretty significantly when you compare it on a year-over-year basis. A year ago it was 899 million. So again, bookings, that very closely watched metric here for Roblox, clearing $1 billion, and we're seeing a lot of that excitement reflected in the move here ahead of the open.
I mean, a lot of bases really covered within this report, even though you're taking a look at a loss, still better than expected. But one of the huge items here to kind of key in on is the hours engaged. That was up 21% year over year. 15.5 billion hours engaged on the platform. Also, you saw the average bookings per monthly unique payer. That came in at an aggregate of about $23.65. That too, up 6% year over year. So with a platform like this, so important to track that incremental value that they're able to extract from some of those unique users that are, or the active users that are on the platform, which you mentioned, up 22% year over year.
All right, well, keep right here on Yahoo Finance. We are about 4 minutes until the opening bell on Wall Street. We'll be right back. Let's take a look at our stock to watch today, and that is Enphase Energy, shares skyrocketing after calming investors' fears just a bit around inventory levels, forecasting a pickup in demand. Yahoo Finance's Madison Mills standing by on the floor of the New York Stock Exchange. And Maddie, maybe we've seen a bottom in some of these solar stocks.
Well, that's exactly what the CEO of Enphase Energy said yesterday. He said that they're expecting to continue to see a little bit more declines, particularly throughout Q1, but that is going to be the bottom moving forward. Zeroing in on that quote, he looked at Europe and California, right? He said that Europe's already showing signs of recovery, and we expect the non-California states to bounce back quickly. He's alluding to the biggest problem there, though, with this name, right? Reminder, Enphase Energy creates some of the parts that go into solar panels. We saw a huge uptick in supply during the pandemic because there was a fuel of demand with people at home installing their solar panels. Now the big question is whether or not everyone who wanted a solar panel has already put that into their homes. We saw that throughout the state of California. We saw it in Europe, and that's what the CEO is alluding to. Having said that, I was amazed this morning to see this name up over 17%. So it's looking like there's some bullish sentiment on this for the rest of the year.
All right, and there's the opening bell on Wall Street as we kick off this Wednesday trading day. Again, investors digesting the batch of earnings that we got out before the bell this morning, hoping that it's going to help regain some of that momentum in the market. You have Sal State ringing the bell at the New York Stock Exchange and Irvin up at the Nasdaq.
Irvin, yeah. You know, you mentioned earnings. I was going to have our theme of today's show be earnings bifurcation. I was told too big of a word for the first 3 minutes of the show. So then I was going to go dispersion. I had to keep going a different direction here ultimately. So we got scattered earnings here today. We'll dive more into it.
You could have done bifurcation.
I thought so too.
Yeah.
Yeah. Jared uses the word bifurcation all the time.
He does. And he is all over this opening bell. We have Jared at the big board. We have Madison still standing by for us on the floor of the New York Stock Exchange. And Maddie, a lot of the concern that's playing out here in the market this morning revolving some of the moves that we saw around one of those regional banks.
That's exactly right, Sean. I'm seeing a lot of green across the major indices, but I want to focus on the negative because why not? While I'm here at the New York Stock Exchange, New York Community Bank absolutely tanking over the course of the past week, erasing about half of their market cap. And this is the bank that had bought all of Silicon Valley Bank's debt, right? And they're dealing with their own debt problems. That's one of the reasons why Moody's cut NYCB to junk this week. And we're seeing that weighing on this name. And the reason that we want to focus on this is because the big question is going to be, is this an idiosyncratic problem or is this an indication of a sickness within the banking industry that's going to bleed into other big bank names? And I was in DC yesterday with the Department of Homeland Security working on a story, and I talked to them about this, and they said that one of the big concerns is going to be commercial real estate and how the big banks are going to handle that zombie problem that we've been talking about for so long. What happens if and when that problem comes to fruition? So certainly something to watch. Also, another name having a really tough overnight here is Snap, erasing about a third of their market cap. I noticed they are up so far in today's trade, so paring back some of those losses. And then later on today, we have the biggest bond auction ever. We've got $42 billion worth of 10-year Treasury notes for sale. That's probably going to be a wait and see story. It's either going to be big news or it'll be kind of nothing burger, depending on what the demand looks like for those 10-year notes. But that's something I'm going to be watching as we head into the rest of the day.
Yeah, we got to keep a real close eye on Snap here. Down 30% right now, of course, off of perhaps some of the lows that we had seen coming in to the start of today's trading session, but $12, not good, not good. Maddie, thanks so much for giving us the tee up there from the NYSE. Jared Blickery standing by at home base here at the Wi-Fi Interactive. Hey, Jared.
Hey, Brad. Home base says that the S&P 500 just hit a record high. Yet another one. Put that in the books. Nasdaq Composite up about 0.5%. The Dow set for a record close, up 1/3%. But you can see the small caps there just in a little bit of red territory. And just looking at the sector action, materials was the leader before the bell, and XLB Materials is the leader after the bell, up 0.75%. Consumer discretionary, energy, tech, communication services, all of those on the top line, rounding out the winners. Only real estate in the red here, but also I should point out XLV holding on to about 0.2% worth of gains here, just hit a record high. Yesterday was the first record high in a number of years, so healthcare bouncing back. I've been talking about the potential for an acceleration, based on this long-term base that it's just breaking out of. And let's take a look at some of our leaders here. We have solar energy, that's probably end phase. That's an end phase story in part. That's up 4.5%. We have Korean stocks, home builders, small oil, all of those in the green. And to the downside, we're seeing some weakness in China and also cannabis stocks.
All right, Jared, thanks so much for breaking down the moves that we're seeing at the open. Well, investors digesting the latest round of Fed speak. Cleveland Fed President Loretta Mester offering a cautious outlook this week, saying, quote, that if the economy evolves as expected, I think we will gain that confidence later this year, and then we can begin moving rates down. Now, this comes after Fed Chair Jay Powell signaled that a March rate cut is essentially off the table. We want to bring in Ellen Hazen, FL Putnam investment management strategist, breaking down exactly what this means for investors. Ellen, when you take into account the Fed speak that we're getting, the fact that it is very unlikely we are going to get a rate cut here at the next meeting in March, and then stack that up against earnings season so far, overall better than expected, what's the biggest driver here for stocks in the short term?
Thanks, Shauna. Looking in the short term, we think that earnings are going to continue to be the growth driver. Whether or not the Fed cuts rates later this year is still very much up in the air. Irrespective of Ms. Mester's comments yesterday, I think the Fed is trying to keep optionality for the rest of the year. They've made it quite clear that March is unlikely. But could they cut in May or later in the year? I suppose. But I don't think that's going to be the biggest driver of stocks. I think earnings is going to continue to be the biggest driver of stocks. And what we're likely to see is a continuation of the trend that we've seen for the last 9 months, which is earnings growth on a year-over-year basis bottomed in Q2 of 2023. It was flat in Q3. It was up in Q4 so far, and it looks as though it's going to continue to accelerate. So if the economy stays solid, as it has been with jobs and unemployment showing such strong gains as they have over the last few months, then earnings are going to drive stocks, and earnings right now look pretty good.
Ellen, is there anything not to like in these earnings reports that we've been hearing so far? We have seen some weakness, at least when it comes to some of the regional plays and some of the bigger banks in terms of their forecast. Does that cause any concern for you?
It's really very company specific. So you've seen some companies have really negative earnings reports, and the stocks that have been more expensive to start with have gotten hit. So you saw Rockwell Automation was one, had a tough earnings report, and that stock had really gotten ahead of itself. Same thing with Air Products. So there are companies that have had weaker earnings or weaker forecasts. And when the stocks were expensive, then they had significant negative stock response. But then you look at a case like CVS, where they lowered guidance for the year this morning, and yet that stock is actually up. So a lot of it depends on the starting valuation, and starting valuation matters with a lot of these areas. It's really stock by stock. As it refers to the big banks, certainly New York Community Bank is in a league by itself at the moment. We think the big money center banks like JP Morgan, Bank of America, Citigroup are fine. We are concerned about the regional banks and the commercial real estate exposure that they have. So we're not active in the regional banks right now for that reason. A lot of them are pretty cheap, so they look interesting, but we want to wait and let the commercial real estate settle out before making any moves there.
Are there certain weak spots that you would feel more comfortable buying into in this market, Ellen?
It really depends on valuation, Brad, again. So in the healthcare sector, there are some stocks that are pretty cheap, particularly some of the healthcare insurance companies like a Humana look pretty inexpensive. And so if the starting valuations are cheap, then they can absorb a little bit of bad news. And healthcare really had a tough year last year, even though a lot of the fundamentals are pretty good. So that's one area that we think looks interesting. But then again, you look at some of the tech stocks that have had disappointments, like Snap, for example, you were talking about earlier, where the valuations are stretched and the stocks have done so well, we're a lot more cautious. One area we do like, though, is semiconductors going forward. And that's true across the board, not just NVIDIA, but a lot of those companies are reasonably valued. They're not really stretched here. And we saw the numbers from TSMC this morning, overnight, where their January sales were up 8% year over year. So that's pretty positive. In terms of the semiconductor inventory cycle, looking like it is coming to an end, and that will be good for the stocks.
All right, NVIDIA striking a $1.7 trillion market cap this week as of right now, trading just below $700 there. Ellen, thanks so much for taking the time here. Ellen Hazen, who is the FL Putnam Investment Management Strategist. Appreciate it.
Thanks, Brad.
You got it. Coming up, everyone, Chipotle blowing past estimates in its Q4 results. We're going to speak with the company's CFO, Jack Hartung. That man right there, next.
Chipotle shares up about 4% after easily beating fourth quarter earnings estimates. Comp sales rising more than 8% from a year ago. And transactions bucking the industry's downward trend, rising 7%. We want to bring in Jack Hartung. He's Chipotle's CFO, joining us now, along with our very own executive editor, Brian Sazzi. Great to have both of you here. Jack, let's talk about this quarter, which was very strong here for the company. You posted transaction growth of 7%. You're doing this at a time when consumers are still facing very sticky inflation. What do you attribute this to?
Yeah, there's a couple things that we saw in the quarter. One, we had carne asada. We brought it back for the third time, and it was better than the first two times. So I think carne asada it's well understood by our customers. Our teams did a fantastic job of executing it. And so when the news came out that carne asada was coming, our customers lined up to come have it again as one of their favorite meals. The second thing, though, is our teams are running great operations. We've seen some of the highest throughput numbers we've seen in 5 years since before the pandemic. So this idea of creating demand where we pull people in or invite people in to try carne asada, but then make sure they have a great experience with great throughput in the restaurant is a great 1-2 punch. And those are really the two key drivers for the quarter.
So it's a gift and a curse, because now you got to keep innovating, Jack. What's that next menu innovation? What is the next carne asada moment for Chipotle?
Yeah, we're going to do 1 or 2 LTOs this year. We haven't announced which ones, but what we've learned is we don't have to come up with something new every time. Our chefs are doing a great job. They're constantly innovating. I mean, some of the stuff they come up with is amazing. But we also know if we have a favorite that we want to bring back from time to time, we certainly can do that as well. So we have lots of options, and our customers really respond. And most importantly, our crews are responding in a big way. It takes a Herculean effort to bring in a new item like this in all 3,400 of our restaurants. And our teams executed at a super high level. And you don't get these kind of results without our crews and our managers just hitting it out of the park.
Jack, perhaps you could break this down for folks that don't have your sophisticated numbers background. So if wages are going up, the minimum wage in California is going up 25%. 15% of your restaurants are in California. Now, as the CFO of Chipotle, do you have to raise your prices 26% so you make profits? And then if you do, what happens to the volumes in those restaurants?
No, we don't have to raise it that much. We haven't made a decision on what we're going to do in California. We're definitely going to have to take action. Really, every restaurant company is going to have to. Our wages, Brian, are a little bit, they're going to go up a little less than that. We're probably more in the 20% range because we're already paying about $17 or a little more than that in California. But it's still a significant jump to go from 17 on the average to 20 is the minimum. So you've really got to average more than 20. To just break even from a profit standpoint, we would have to take a mid to high single digit, say call it a 5, 6, 7% increase, something like that. For us to maintain our margins so we don't dilute margins, it would be something like a high single digit number. So maybe in that 8, 9% range. Significant increase, but, and again, we haven't decided what we're going to do, but it's probably going to be somewhere within that range.
Jack, you've been, you're basically like day one at Chipotle, but you've spent your whole career pretty much in the restaurant space. I mean, what do you think about this policy in California? Because it's not just going to be Chipotle having to raise prices. All of your competitors are going to have to raise prices, and it could really hurt a lot of consumers.
Yeah, here's the thing that is unfortunate here is this act was aimed towards, large restaurant chains. And, large restaurant chains like Chipotle can afford to do this. We have scale, we can find efficiencies, we have menu pricing power. It doesn't technically apply to individual business owners. It doesn't apply to businesses outside of restaurants, but they're all going to be affected. So when restaurant wages and the restaurant industry in California is the largest employer in the state. And so when that many people are going to get a significant raise, it's going to have a ripple effect. It is going to make things more expensive. I do think it's going to have an inflationary impact and make it a little tougher to go to the grocery store or stay at a hotel, and of course, eat at a restaurant, whether it's an independent restaurant or a chain restaurant. We'll see how it plays out. I think we're really well positioned, Brian, to handle this, but it's going to have an impact for sure.
Yeah, Jack, raising prices is just one of these methods that you could use here in order to cope with the higher costs. There's also been talk, at least from some of your competitors, about restructuring their employee headcount, what exactly that could look like, whether or not they're going to implement hiring freezes. Is that something that you're considering?
We're not considering that at all. I mean, our restaurant starts very early in the morning, 7 or 8 in the morning, with prep work. Our restaurants don't open up till 10:30 or 11, but we have whole onions and peppers, and we're mashing guacamole, and we're marinating meats. There's a lot of kitchen work that needs to be done. We need in each and every one of those employees early in the morning. And then, of course, we want to continue to drive great throughput. You can't drive great throughput unless you have a full complement of well-trained, talented crew on the line. So we're not looking at cutting our crew in the restaurants at all.
Jack, as you were talking about the number of locations that you operate, I couldn't help but think back to what you were talking about on the call with regard to this economic environment, specifically as it relates to Fed policy and rates, and how that also influences construction for new locations that you're looking to move into. How much does rate policy directly flow through to the growth ambitions for Chipotle?
Yeah, it hasn't affected our growth too much. We have enough capital, so we're not in a borrowing position, so the higher rates don't affect us directly. What it does do, though, is our developers, a lot of them are pausing. They tend to leverage the developments that they're going into, and we rent the vast majority of our sites. So our developers are pausing a little bit. The returns that they need, the cost that it takes them to go into a development so that we can rent one of their spaces has gone up. So it has slowed down the pipeline a bit. It has added to costs. There's been inflationary impact on the materials that go into construction. There's been inflationary impact on the labor, and then this higher cost of interest, is inflationary as well. So it has put a bit of a challenge into our economic model. But our economic model is so strong to begin with, we can withstand this, and so we're not slowing down. It has extended our timeline, but we expect next year to increase our openings. We're going to open between 285 and 315 restaurants. That will be an all-time record for us. So we continue to grow.
Jack, I've always viewed the secret ingredient for Chipotle is the employees, your ability to continue to promote from within. People that started cooking food are now running a large amount of restaurants. Perhaps you could talk to investors here and explain to them some recent initiatives that you put into place to retain your talent, because I really think that's helping to drive your results, and it continues to drive your stock price.
Brian, you're 100% right. Not only does it allow us to grow, it allows us to own our own restaurants. And when you own your own restaurants, you can do things like navigate through a pandemic, handle inflationary pressure like what we're dealing with, in California. 90% of our restaurant leadership came from crew. Last year, we promoted 24,000 people. So no question about it, our crew is our lifeblood. It's our future. It's where our future leaders are coming from. And we've done things over the years, like we have debt-free degrees, so we'll invest in the development of our folks. That tends to lead to them tending to stay longer at Chipotle, so they will stay a lot longer. It tends to lead to them moving into management ranks as well. So when we invest in our people, they will invest in themselves and they will grow their careers with us. Most recently, we added some benefits around mental health. Mental health is a big concern of our crew. We tend to have a very young crew. We also just added a new benefit, which really allows our folks to pay off student debt. And the idea here is, as our employees pay off student debt, we will have a matching contribution to the retirement fund. So a lot of folks, young folks, are thinking, do I pay off my debt or do I save for retirement? But they can't do both. In this case, they really can. They can pay off the debt, and then we'll have a matching contribution towards a retirement. And we think that's a great added benefit that we just rolled out this year.
Well, we are also especially thankful for those employees when they also give us just a little bit more chicken, too, and are malleable to that request here, Jack. Certainly do appreciate the time, as always. Jack Hartung, who is the Chipotle CFO, alongside Yahoo Finance's executive editor, Brian Sozzi. Thank you.
Thank you, guys.
All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Disney doubling down on sports streaming, teaming up with Warner Brothers Discovery and Fox to launch a brand new service. Yahoo Finance's Alexandra Canal is here with what we could expect there. Allie.
Guys, doesn't this sound familiar?
It does. Way too familiar.
Sounds like the cable bundle. Everything old is new again, but this is going to be available as a standalone app. You're also going to be able to bundle this with a Disney Plus subscription, Hulu, Max, and each of these companies are going to own a third. And that's very important here as we think about the cost of sports rights. That's gotten so expensive. We have the NBA renegotiation deal coming up, and they're expected to fetch a very high price point. And this could essentially change the game, especially since all three of these companies make up about 55% of the sports rights on the market right now. But again, a big question I have is, will the consumer buy in? I thought we wanted to get away from cable. I thought we wanted to get away from the bundle, the ads. All of that is back in action, and it doesn't seem to be going away anytime soon. Price point, how much consumers are willing to pay. We were just talking about all the bundles, subscription plans that we pay for. It's a heck of a lot of money. And, we have seen hints of this in the market. We have third-party bundles. If you're a Walmart Plus subscriber, you get Paramount Plus. You also had Verizon recently come out with a bundle with Netflix and Max. So we have seen hints of this, but I think this really solidifies where things are at in the current market and what it could potentially signal for linear TV.
All right, Allie, stick around. We've got much more on this conversation right now. The team up of Warner Brothers, Discovery, Fox, and Disney's ESPN shaking up the sports arena, but it's also a big hint about the future of streaming. Here for more insights, we've got Mark Boydman, who is the partner and head of global media over at Solomon Partners. We're also joined by Alexandra Canal here in studio. So, Mark, take us into this one. As we were just talking about, this essentially just sounds like cable all over again.
It does. It's a nice flashback to the old ways. But the interesting thing is that these companies need to come together. Bundling has been part of the driving force, but as has the cost of sports. The cost continues to go up. As Ali just mentioned, we're hearing rumors of close to $75 billion for some sports programming that's coming up. And that's a big number. And so you bring these companies together, it takes the competitive tension out of the mix. You have consolidation. So companies coming together, bidding on potential sports rights could be interesting. We don't know if that will happen, but that's certainly something that we project could happen. And that would be very interesting to see when they come out with this new programming, how much does it cost every month? And as Ali mentioned, the costs continue to go up for subscribers and streaming services. And at some point, they do get tapped out.
And Mark, I wanted to pick up on that point on costs. We've seen estimates on the street anywhere from $35 to $40 a month, but considering we've seen increased churn, even when the most basic of services raise prices, is that a price point that you think consumers would be comfortable with? And does it make a difference that it's sports as opposed to pure entertainment like television shows or movies?
Yes, that's exactly right. It's going to be expensive. But relative to what you're paying for cable, maybe not, right? So the reality is, those who do decide to stream this service will have cut the cord. And so people are thinking about that as they think about, okay, am I going to pay 30, 40, 50, even more per month for streaming services? They think about the cost differential versus their cable programming. And as these companies think about pricing this plan, they're going to think very carefully about how people are paying for what they're paying for today to offset any losses. So the reality is the consumer should win here because you'll have more choice. But the question is, will you actually want to fork out that amount of money for this programming? And it all depends on the quality of the content. And it sounds like it's going to be robust.
Mark, what do you think this means for these companies' bottom lines? We talk about the fact that so many of these streamers or streaming services, I should say, struggle to get to profitability. Obviously, that has been a massive concern here. When it comes to Disney, how much is this really going to move the needle in order to inch them closer to some of those profitability targets?
Sure. Rather than comment on Disney in particular, let's just look at the whole landscape, right? And if you think about every company in this sector, they're all trying to figure out the path to profitability. They have a revenue stream today that they need to protect, right, with those who subscribe to cable networks. And if you think about the future, by 2027, cable TV penetration is going to probably drop to about 35, 40%. So you're going to see, rapid deceleration of cable households. How do you protect that revenue stream? You have to offer programs like sports programming through streaming. They don't want to see consumer habits change too much. Young people today, they're okay getting highlights for sports through various streaming applications. How do you make sure that those streaming highlight users don't disappear completely? You need to make sure you engage them with live live sports content and live entertainment. And again, the reason why we see companies coming together, because we believe in the medium term, it's going to allow them to better compete for this content, which is extremely expensive. And it's also going to allow them to absorb the cost together as a group, as opposed to each of them individually going after the same content.
And Mark, Fox reported earnings this morning. On the call, management talked about this deal at length. They said they are targeting the cord nevers, so those that never subscribed to cable in the first place. Do you think ultimately that will be the case? And if not, is that going to speed up the demise of linear TV?
Yes, that's exactly why they're having to think about all of this, because they want to make sure that people who don't ever subscribe to cable or those who leave cable don't leave sports live programming. There's an opportunity to get them with great content. That content is getting more expensive. And as we see a lot of young people today who are just used to getting content anywhere and everywhere and having that flexibility and being able to watch live sports streaming on the train, on the subway, even potentially on an airplane, as we're seeing those streaming services get more powerful. This is what is driving these companies to say we need to open up our playbook and revisit how we're going to provide content to our consumers. And that is what is driving a lot of these discussions. But to be honest with you, it is a very unclear future for a lot of these streaming companies. We don't know, and we talk about streaming wars, but it's hard to say. We can tell you that cable TV network penetration is going to drop significantly in the next 5 years. We don't know which streaming companies and which platforms are going to thrive, and frankly, which are going to survive. And so coming together, these consortiums are interesting from a marketing standpoint, getting people aware that they exist, getting people to realize that there are offerings out there for them that meet their needs. It's a big challenge for a lot of these companies. And coming together makes it potentially even more challenging, but also allows these companies to use their marketing muscle together to get word out for young people who never had cable that this programming is available to them. And we think young people, those who never had cable, are going to want to look into this, but at the same time, they're also going to be looking into, how do I get this content for free? How can I figure this out? Is there a way around this? And if there is, then these networks are going to have challenges for sure.
Mark, I'm one of those people always looking to save a buck or two. All right, Mark Boyman, great to have you. Thanks so much for joining us here this morning. And of course, our thanks to Ali as well. All right, we'll keep right here on Yahoo Finance. Much more of your market action ahead. Again, we're about 30 minutes into the trading day. You've got the Dow up just about 100 points. We'll be right back.
Welcome back. I'm Brad Smith alongside Shauna Smith. We're about 30 minutes into the trading day. Let's take a look at how things are shaping up right now. Stocks rising this morning as investors digest a fresh inflow of quarterly earnings with debate over the timing of interest rate cuts. That still hums in the background.
All right, let's take a look at some of those individual movers. Fortinet jumping this morning on the heels of its quarterly results. Now we're looking at shares of just about 2%, have been up about 10% in pre-market trading. Now the cybersecurity company beating the street's expectations, reporting stronger than expected revenue and billings. That grew 8.5%. Results defying some of the fears of an ongoing slowdown after cyber spending continued to slow last year.
And Hilton shares moving to the upside right now by about 0.6%. The hotel operator posted a beat on both the top and bottom line, reported softer 2024 guidance thanks to higher expenses and signs of slowing demand for leisure travel across the U.S. For a deeper dive, though, into the company's latest earnings report, I'll speak with Hilton CEO Chris Nassetta at 11:50 a.m. Eastern Time today. You do not want to miss that.
We surely do not. And then we're also taking a look at Target, seeing a nice pop this morning. The retailer reportedly weighing the idea of rolling out a new paid membership program that competes with the likes of Amazon Prime and also Walmart Plus. This is according to Bloomberg. You're looking at a move of nearly 2% here at about 30 minutes into the trading day. But this has been rumored now for some time. There has been talk that Target should have a subscription service similar to its rivals, given the fact that Walmart and Amazon has been so successful with many of those those recurring types of orders. So I think if Target is able to execute this, and if in fact this report is true, it could be good news here then for shareholders.
I am so surprised that this hasn't already been in the market. I mean, I've practically furnished an entire apartment from Target, a previous one, not this current one, but Target has some very valuable stuff for the apartment dwellers here in New York City. But no doubt, it's a larger question of what type of pricing mechanism they would put on this, what the rewards profile would be, and the redeemability of many of those compared to some of the other offerings that are currently in market from either Costco and the membership program that you got there, or Walmart, as you mentioned, a little bit more analogous or synonymous.
Yeah, and also just points to the fact that they're looking for ways to stem some of the losses or the declines that the business has seen. We talk a lot about the fact that consumers are under pressure. They're no longer spending the bulk of their money here on discretionary items. Instead, they're being forced to only spend on consumer staples. Target, one of the companies that have been challenged just a bit, given that shift that we've seen in spending. So something like this, a subscription service that really is centered more around staples, could potentially boost the business.
Some sort of guaranteed revenue, at least in those line items. Also, we're tracking Ford here this morning. Ford riding high off of its fourth quarter earnings beat. Shares up a little more than 2.5%. The company projecting a full year profit outlook that beat estimates here. One blip, the automaker still sees more losses in its EV units amid an industry-wide slowdown in demand. Consumers still aren't sold on vehicle pricing, lack of charging stations, and battery range. Ford CEO Jim Farley spoke about the company's EV investments, touting an internal team that's working on making a low-cost EV to compete with Tesla and Chinese OEMs. For more on this, we turn to Tom Narayan, who is the RBC Capital Markets lead equity analyst for global autos. Also with us, we've got Michelle Krebs, who is the Cox Automotive executive analyst. Michelle, I'll begin with you because as we think about this broader kind of landscape for many of the auto manufacturers, especially the big three here in the U.S. that have had to look across their own ambitions for EV saturation and had to pull back on that just a little bit, where does that then shift some of the focus in this near term from your perspective?
Well, we've said that the focus, the forecast now is gone from rosy to realistic. I think what has happened is everybody's on the EV train, and but not all consumers are, and so we're seeing a lot of new models, a lot of production of EVs, but the demand is not there. That's not to say that EVs aren't still increasing in sales. We anticipate they'll have another record year this year as they had last year, but it is forcing automakers to look at what is their timeline in terms of rolling out new EVs and how they're going to spend their money.
Tom, when you take into account what we did hear about the EV strategy, the shift that we have seen play out of Ford, comparing that to the rivals and the other automakers that I know you cover very closely, how does Ford stack up to some of its largest competitors?
Yeah, and I think we learned that from the call yesterday. I think Ford intentionally went headstrong into They were an early adopter of EVs, and I think it's kind of hurting them right now, to be honest. Take a look at Stellantis in the D3. They were kind of later to the game, and it's kind of benefiting them. Ford really has no choice but to really commit. That said, at the end of the day, this is an evolution. We are moving towards electrification. So these bets will eventually pay off. It's just that right now, and we heard this from the Tesla call as well, we're in kind of in between two waves, and it could be a little challenging for some time.
And so how do you price that into the valuation from your perspective, Tom?
Yeah, so I look at the guidance that they gave, 10 to 12 billion of EBIT, and my EBIT actually didn't change all that much. It stayed at around 10 billion of EBIT, and the reason is I do think these EV losses that they're calling for, if you annualize the Q4 losses, you get something like negative 6.3 billion, and they're calling for 5 to 5.5 billion. So, I think that could be a challenge for them. So I'm calling from the low end of their guidance range. And then I do a sum of the parts valuation, and I come out to a $12 per share valuation. That isn't to say that, the pro business they have is amazing. It's one of the best businesses in autos. It's just that EV drag is just really painful for these guys. It's half of their entire EBIT is coming from that. And we just don't have the evidence yet that that's going to turn around next year, even though, they say it will.
Michelle, we've seen the price wars play out. Obviously, it has been a challenge, a headwind here for so many of these automakers. When you take into account, Michelle, what we heard from Jim Farley last night, also the fact that Ford now seems to be focused on this cheaper EV, do you think we're going to see continuation of these price wars, given the fact that consumers are very much still under pressure?
Absolutely, especially in the EV segment. We have double the inventory of EVs that we have of regular gas power or total vehicles. And so that means there will be more incentives, there will be more discounts, there will be more price cuts. So it's going to be a very cutthroat business in the next year or two.
And with that in mind, what do consumers need to see from what you're hearing on the Cox Automotive side in the broader infrastructure for electric vehicles to feel comfortable buying into them, to get to some of the targets that Tom was just talking about, these automotive manufacturers have laid out?
Well, first of all, price. That's always been the number one barrier for EV adoption, especially as we move into the more mainstream buyers. So far, a lot of the EV buyers have been very affluent. They probably have multiple vehicles in the household, but now we're moving into that heart of the market, and that's going to be a bit of a tougher sell. So price is one, but the EV charging infrastructure, it needs to be more expansive, but it also needs to be maintained, because we have seen just horror stories of, there was one in Chicago during the storm of, people waiting for chargers. They drive up to one and it's not working. So that's got to be worked out as well.
Just lastly, would love to get an answer from both of you on this. When you think about the interest rate environment and how much consumer sentiment is tied up within that, especially for financing large purchases like automobiles, if we do see cuts and the pace of cuts perhaps that were anticipated by some consumers and economists out there for this year, what will that do in terms of perhaps a dam-breaking type of moment for people getting back into purchasing in the automotive market? And Michelle, I'll go to you first, and then Tom, would love to get your thoughts.
It certainly will be a huge help. High interest rates have pushed a lot of people out of the market, have pushed the monthly payment really high to the point that some people just walk away. So that will be a huge benefit. I would say the number one thing for consumer sentiment, though, is gas prices. If you watch gas prices, that's where consumer sentiment goes. But interest rates are not far behind.
Fair point. Tom?
Yeah, I totally agree with that. The interest rate environment is what Elon called out every one of his earnings calls, right? It totally impacts affordability. What we're noticing, though, is that the pricing is at all-time highs. So the concern would be is if affordability is in question, if pricing collapses, that is really problematic for these OEMs. So if interest rates do come down, affordability is maintained, they could have another record year of profits. So it is of tantamount importance. It's also important for the EV story, as we talked about earlier, pricing, I think, after charging infrastructure is the #1 problem people have with EVs. Those prices need to come down.
Tom Narayan, Michelle Krebs, always great to get your insight. Thanks so much for joining us here today.
Thank you.
Keep right here on Yahoo Finance. Much more of your market action ahead. We'll be right back. Uncertainty over the timing of the first Fed rate cut has put investors on edge, but there's one area that's helping to reassure the street, and that's fourth quarter earnings. Now, 2/3 of the S&P 500 companies have reported results so far, and data out from Bank of America showing that over 70% of companies that have reported have beat. That's above the historical average. We want to bring in Neil Mukherjee. He is a TIAA Wealth Management Division's Chief Investment Officer. Neil, it's great to have you here at the desk with us. Let's talk about earnings focus right now in terms of the reports that we've gotten so far. Better than expected, at least when you take a look, a wider look at the majority of earnings that we've gotten. Is that enough, though, to keep the market's momentum intact?
Yeah, it's a great question because all of 2023 was about valuations. And this year, the focus is going to be on earnings, and earnings better deliver for the stock market to move forward. And like you said, earnings are coming in better than expected. That's great news. It's still tracking roughly mid to low single digit in terms of sales growth, earnings growth. So it's not that stellar, but it's better than expected. The key question here is, does technology keep powering through with their earnings growth? And they have been the biggest contributor to earnings in the fourth quarter. They're expected to be the biggest contributor in Q1 as well. If technology doesn't deliver on their promised earnings and they don't deliver better than expected, I think in 2024, that could be volatile for earnings as well as the stock market. One swing factor, I know the consensus is pricing in about 10% earnings growth, is the cyclical sectors. If they begin to participate, there could be more upside.
What's the specific area within technology, though, that needs to stay strong in order for the rest of the market to just kind of hang on the coattails for the near term?
Well, I think it's the secular growth areas, really. So within technology, we still like software. We like areas like cybersecurity, artificial intelligence, cloud computing. Cloud computing, remember, if you go back a few years ago, everybody was talking about cloud computing, and now it's like being replaced by artificial intelligence. But go back to cloud computing. We may be in the fifth inning here in the US in terms of companies transforming to the cloud because it lowers their expenses. Outside the US, we're in the first inning. So this is a long-term theme. So those are the areas that we would focus on. Technology, a little bit extended. We're being selective. We're favoring those names which have rock-solid balance sheets, and they have access to those total addressable markets that I talked about.
Yeah, one of the criticisms of the market's momentum that we've seen, obviously, is that a lot of that has been driven by just a handful of tech names. We started to see a little bit more of a broadening out in participation. If we don't see more of that ahead here in 2024, what risk do you think that poses to the market?
It does pose a risk because if you look at the top 10 stocks in the S&P 500, they're more than 30% of the index now. And those same top 10 names are contributing roughly 20%, 20 to 23% to the earnings of the S&P. So they're punching above their weight slightly, but not too much, because the growth rates are pretty stellar in those areas, which is why I said they better deliver on those growth rates for the markets to do well. But I do think the concentration risk is there. The biggest thing for the markets this year is going to be the Fed rate cuts. Earnings is number one, Fed rate cuts is number two.
Just how much wind could the Fed take out of the sails of the market if we don't hear the number of rate cuts that we want to hear?
It's a good question. One thing the economy has done is it's proved everybody wrong because the economy is still powered ahead despite all the rate hikes that the Fed has done.
A red-hot jobs print that we got just last week.
350,000 jobs in the month of January blew out all expectations. So the economy is still good. So it's going to be a combination of economic growth and the Fed rate cuts, which will lead to earnings story, which will lead to the stock market story as well. So the Fed can introduce volatility if they push back on this notion of rate cuts. You saw Neil Kashkari this morning say 2 to 3 rate cuts. The Fed has said 3 rate cuts. The market loves to bully the Fed. They went ahead and priced in 6 rate cuts. Chair Powell came back strong and said no March cuts are going to happen. So this push and pull will happen. The bottom line is, the market is pricing in a decent number of rate cuts. And if they don't get a majority of that, that will introduce some volatility. The other thing I'm worried about is if interest rates don't come down, or if they actually go up, then that will put more pressure on the smaller companies in the equity universe. They have weaker balance sheets, weaker earnings, and those are the companies which employ the bulk of the people in this country. So that is a concern as well. So how much volatility? It'll depend on the combination of the economic strength and the Fed rate cuts. The Fed, I think, will deliver. I think inflation has gotten to a point, 2% on a 3-month, 6-month annualized basis. It'll be good for the Fed to, they're seeing the probability of a soft landing right in front of them. The door is a little bit cracked open and they're going to try to walk through it. They're going to normalize interest rates. That's usually good for equities and bonds. If they have to cut because the economy is going into a recession, that's a different story. But right now it looks like soft landing, normalizing interest rates, Fed cuts, that's a good combination.
How many cuts do you think would make sense at this point? Obviously, there's a lot of uncertainty, but given what we know now.
Yeah, I think 2 to 3 makes a lot of sense to me. 3 is a good number, I think, to go by. And I think Chair Powell was good to push back on the March rate cut, and the market has almost faded that out now, so which is good. I think 6 seems excessive to me because 6 is good in the sense that if we have a recession, 6 and more makes sense because 3 rate cuts to me sounds like a good number. So I'm almost seeing this environment in the context of what happened in the mid-1990s. So where we had the soft landing. So mid-1990s, in 1994, the economy was in the third year of an expansion, recovering from the 91-90 recession. The Fed was getting a little bit worried about inflation. They hiked interest rates by 300 basis points. They went from 3% to 6%. Inflation moderated. In 1995, they pivoted. They cut interest rates 3 times. So they just adjusted the policy rates lower, not necessarily went all in on a rate cutting cycle. That led to the soft landing, and we all know that set us up for the rest of the decade, where we had 3% average GDP growth, employment was stable, interest rates were stable, and the stock market did what it did. I think the Fed sees that situation forming and the productivity stories coming through. And like I said, the Fed will try to calibrate interest rates lower without either doing too much or too little.
Neil, great to have you here in studio with us. Thanks so much for taking the time and the context and insights here. Neil Mukherjee, who is the TIA Wealth Management Division Chief Investment Officer. Appreciate it.
Thank you.
Absolutely. Everyone, coming up, we've got all your markets action still ahead. Stay with us. You're watching Yahoo Finance. Edgewell Personal Care seeing sales rise over 4% in the first quarter, with strong international performance offsetting a sticky consumer backdrop. The owner of Schick and Banana Boat did, however, see profits slip from a year ago. Dan Sullivan, who's the Edgewell Personal Care CFO, joins us now. Always a pleasure to catch up with you here. First and foremost, we got to know, what were some of the largest catalysts for this quarter, and does that trend remain true from your perspective for the rest of the year?
Yeah, good morning, Brad. Thank you. Great to be here. Look, we had a good start to the year. We delivered about 3% organic growth. As you mentioned, we saw heightened growth internationally, double-digit growth. Share performance was solid across the U.S. We gained share in key markets like Germany and Japan. And I think most importantly, we saw a real catalyst in the quarter around our gross margin profile, 200 basis points of year-over-year gains, which certainly bodes well for the year. In terms of growth, I think what we are seeing right now is really strong brands on shelf, good distribution outcomes, some interesting innovation that's now making its way to the consumer. And in certain markets, mostly internationally, we continue to take price. Japan is a great example of that as the market leader. So all of that does bode well. We have a guide out for the year of 2 to 4% growth at the top, and so Q1 slides in quite nicely into that outlook.
Dan, you mentioned the better than expected improvement that you saw in gross margin. I'm curious, what do you attribute that to? What are some of the changes or strategies that you have implemented in order to increase that and better position the business?
Yeah, we saw great execution from the team on both sides. On the cost side of the house, we have a program called Project Productivity, which delivered meaningful cost savings for the organization, north of 300 basis points of cost takeout. We also saw revenue gains, about 200 basis points. That's pricing, but that's also what we call strategic revenue management, right? So how do we think about interesting innovation? How do we think about promotions, contracts with retailers? And so all of that, the team executed extremely well on. It was a bit of an outlier. It was stronger than we thought it would be, but both of those led to the strong margin profile.
What type of resilience do you see in self-care? And particularly, I think I think about my own activities here, Dan, and I'm just going to make it personal. My own self-care Sundays or self-care Saturdays that I have, there's a lot of your products, perhaps, that many other people out there, they might lean into the same way that I do. When you think about the resiliency of little luxuries that people might tap into if they don't feel as confident making big ticket purchases, how does that bode for Edgewell, and where is that showing up within some of your segments?
Yeah, look, consumers want simplicity, right? Particularly male consumers. They want simplicity in the regimen. They want products that can solve multiple hygiene challenges and regimen challenges for them. You see that in categories like shave, which are now moving more into a hair removal play. We've brought dermaplaning on the female side of the equation as a good example of that, as women haven't gone back necessarily to the behaviors pre-COVID where it was spa-based and doing much more at home. I think most interestingly on the consumer side, though, what we see is a consumer that continues to spend on themselves, continues to search for interesting experiences for themselves. That bodes well for travel, beach, being out in the sun, being out with friends. That behavior is still there. We saw a spike post-COVID. That behavior remains, and certainly as the leading sun care portfolio in the U.S. bodes well for us heading into the season.
Dan, have you seen at all, though, consumers trading down in terms of your products and the more affordable lineup that you have at Edgewell? Are you seeing a little bit more traction there?
We've not. We don't see any real signs in our category. And in shave, we would see it, Shauna, because we operate across all three subsegments, right? Branded, disposable, and private label. And if you look at consumption patterns, behavior, you're not seeing any real shift in terms of the last 12 to 18 months. That's why we say I think the consumer is resilient. We're also operating in categories that are certainly not discretionary in nature, and so we benefit from that. We're also mid-priced in terms of mid-tiered in terms of pricing, which also helps as well.
Dan, I think we spoke with you about this last time as well, and we'd just love to get an update on this front. I mean, when we think about the different retail operations that your products go into, are you seeing any friction where there are some of those retail locations where there's, plastic glass and you got to wait for an associate to come over and get some help? I mean, I know in my own cases, there's at least been a few occasions where I've said, I don't have the time for this. I'm just going to come back, or, you miss out on a purchase from me.
Yeah, look, it's real, right? What you all see and hear in terms of theft and shrink at retail and the challenges that retailers have to protect product while not disturbing sales, that's a real challenge. It hasn't necessarily impacted our categories per se. We're obviously at very different price points than some of the things that retailers might be more interested in protecting on shelf. We've also seen a pretty healthy balance in online sales. The Billy brand obviously is a catalyst for that. So we also see a consumer that is now more open in our categories to buying online and in store.
Dan, a lot of people already know the brands that lie underneath of Edgewell. Is there another brand out there that is attractive in sort of an acquisitive mindset that you think needs to be added in, or at least a segment that looks attractive for Edgewell to buy into?
Yeah, look, we've made some really interesting acquisitions, Billy being the most recent, and hopefully you saw the news earlier this week as that brand now moves outside of shave and into women's lifestyle and body. We've made acquisitions with the Cremo brand and Bulldog. We are not necessarily prioritizing acquisition at this point. We look at a lot of assets. We look at a lot of brands around skin, grooming, and sun. The cost is still high, and I think most importantly, we feel really good about the portfolio we have. We don't see any needs from a portfolio perspective. Again, we're going to stay active, we're going to stay involved, but nothing imminent.
Man, I've been pronouncing Cremo wrong this entire time, so thank you for that, Dan. I appreciate it. Dan Sullivan, Edgewell Personal Care CFO. Thank you.
Thank you.
Switching gears here, CVS, fourth quarter earnings surpassing expectations, but the pharmacy giant is not immune to higher medical costs infecting the healthcare sector, cutting its full year profit outlook. And for more on the impact of medical costs to CVS and what it means for investors, we've got Jessica Tassin, who is the Piper Sandler healthcare analyst, here with us. Jessica, great to see you. As you kind of review and go through this quarter, what jumps out to you as impacting this company's outlook?
Yeah, so I would call this a better than expected quarter and a clearing event. So in the fourth quarter, you saw medical loss ratio come in at about 88.5%, which took the full year number to 86.2, or about 20 bips ahead of guidance. That's just reflecting, again, continued cost pressure in the Medicare Advantage business. I would say, importantly, CVS had telegraphed the potential for this MLR miss to occur during a public appearance in January. So we think that the MLR miss was anticipated, but what maybe surprised some investors was that the pharmacy and consumer wellness business was able to more than offset the headwinds in the insurance business to ultimately drive a 4-cent EPS beat versus the high end of the 2023 guide. So I'd say the important takeaway for us is just, again, the power of the diversified business model. We think that there are natural hedges built into the CVS business due to the company's unique combination of managed care, pharmacy, and healthcare delivery and services assets. And we saw that in the fourth quarter.
Yeah, Jessica, talk to us a little bit more about that, the hedge that they could have or they do have in your belief, given the diversity of their offerings. When it comes to the outperformance that maybe we saw on a relative basis, given the fact that they did forecast a lot of the troubles that they were seeing, what does that transition year then look like, do you think, for CVS?
Yeah, so I think what's important is just that the pharmacy assets and their healthcare delivery and services assets have the potential to mitigate some of the cost pressure that we fully expect to see in the Medicare Advantage business in 2024. Again, we saw evidence of that in the fourth quarter, where the pharmacy and consumer wellness business was able to more than offset the softness in the insurance business. And we'd expect that dynamic to continue in 2024. In 25, it becomes even more compelling a story in our view, as you have the recently acquired Oak Street Health assets continuing to scale and again mitigate or helping better manage costs in the insurance part of the business.
And so within that insurance part of the business, I mean, we've been watching a lot of the insurers who have been reporting over the course of this season kind of get hit on the amount of people that are just coming in and needing to take advantage of specific services. Kind of long-term prospects here, how much of a weight do you believe that still could have over the future and coming years as we're thinking about aging population as compared to years and decades past, I guess?
Yeah, I think it's an interesting question. So what we're seeing is a combination of things in 2023. You have a rebound in what's considered kind of normal or healthy utilization, right? Seniors who hadn't been getting elective surgeries because of COVID are now returning to outpatient surgery centers and having things like hips and knees done. In addition to that, you've got utilization of supplemental benefits in Medicare Advantage. So things like dental and hearing benefits came in perhaps above expectations in 2023. So for 24 and 25, looking out, I think the managed care companies have largely anticipated a continuation in what they've considered healthy utilization. Again, things like outpatient surgeries for elective procedures. In addition to that, I think just given the experience in 2023, you have a better forecast of utilization on the supplemental benefit side. And then as we look to 2025, right, you have again, these trends continuing, but the potential to price more favorably for the continuation of that utilization.
Jessica, what about the pharmacy side of the business? Clearly, a lot of these pharmacies are understaffed. They've had trouble getting the workers that they need inside the doors, the long lines. We also know what played out in Ohio, where they were fined about $250,000. How big of a challenge is that for CVS in the short term?
Yeah, so I think CVS has actually implemented a number of efficiency initiatives at their retail pharmacies, and they're at this point the predominant retail pharmacy in the country, right? I think 85% of the population lives within 10 minutes of a CVS. So I think the company is beginning to appreciate that these 9,000 retail pharmacies have the potential not only to support, retail prescription delivery, but also to be a site of care for the vast majority of the population. So I think these are unique assets. CVS is benefiting from pressure or the bankruptcy of competitors, candidly. And I think that they are better managing workflows within each of their pharmacies to allow pharmacists to practice at the top of their license, to consult on medications, to deliver vaccines, and to act as care delivery providers in the community.
Certainly. Well, they have struggled in that part of the business, at least just in terms of getting the staffing to the levels that they need. Jessica, great to have you. Thanks.
Thanks.
Coming up, credit card delinquencies jumping 50% in the fourth quarter of 2023. We're going to dig into the numbers and whether or not this is a real red flag for the economy next.
Credit card balances rose 4.6% in the fourth quarter of 2023, topping $1 trillion according to the New York Fed. Still, credit card debt relative to the money American households have in the bank is near 20-year lows. So here to talk about the state of the U.S. consumer is Matt Schultz, who is the LendingTree Chief Credit Analyst. So if you're to encapsulate exactly where things actually stand, even as we have what seems like an extremely high relative to previous levels, credit kind of holdings and credit levels for credit cards for consumers versus the amount that they are actually keeping in the bank, where do we ultimately net out here, Matt?
I think where we ultimately net out is that people are doing okay right now, even though there's a ton of credit card debt and delinquencies are still rising. But the truth is that an awful lot of people are a little bit on that edge where it wouldn't take a whole lot, whether it's a job loss or a medical emergency or even just kind of a reduction of income, to shift from feeling pretty good about things to being pretty concerned. And given that this is all happening at a time of generally really low unemployment, albeit with layoffs picking up and that sort of thing, it's certainly reason for concern.
And man, it's important to put this in perspective, right? We still aren't anywhere near the levels that we saw during the height of the Great Recession, obviously. But when it comes to the pressure that is on the consumer right now, exactly what this could mean then for spending trends, how quickly do you think that landscape could potentially deteriorate, given the fact that we are getting these numbers, that it is such a jump?
Yeah, it's tough. A lot of it's going to depend on how inflation keeps trending. There are reasons to be hopeful as far as that goes, and that's a positive sign. There's also reason to be hopeful as it relates to interest rates. I don't think we're going to see them lower in the next couple of months, but certainly by the second half of the year, I would think we would. But the truth is, again, that a lot of people over the years of inflation, rising interest rates, have seen their financial margin for error in their household shrink from a pretty small amount to almost zero. And that forces a lot of people to rely on credit cards as kind of an emergency fund type of thing. So I think that there's reason to think that things may get a little bit worse before they get a little better.
How much worse, Matt?
Well, it's hard to say. I think the numbers that we get next quarter are going to be really telling, because in the fourth quarter, we pretty much always see credit card debt rise, but we also often see it decrease in the first quarter. And in 2023, we actually saw it stay flat. And it was the first time in a long time that we hadn't seen credit card debt decrease in the first quarter, and it was a really bad omen for the year ahead. What we are going to see next quarter, I think, is going to be pretty telling.
It's interesting, Matt, because you'd mentioned and alluded to interest rates as well, and it was particularly noteworthy because I harken back to the consumer confidence most recent reading that we saw, and in a comment from Dana Peterson, who's the chief economist at the Conference Board, she had mentioned that consumer confidence likely reflected slower inflation, but also something that you mentioned, anticipation of lower interest rates ahead. Just how many cuts or how deep would the cuts need to be in aggregate, perhaps, for consumer resiliency or even a comeback in or furthering of some of the trend that we are seeing in consumer confidence?
Well, honestly, I think even just a cut or two is going to make people feel better. It may not make a huge impact on their monthly bills, but I do think that after taking gut punches for 2 years with all of these interest rate increases, I think when people see that we really are on the other side of that, it'll help people feel better about things. In order to actually have a real impact on their bills, it's going to take a handful of decreases, and that'll take time. But just the fact that we see light at the end of this tunnel, it'll be a positive thing.
Matt, I need a personal finance tip, not from me, but for the person perhaps next to me.
On the other side.
On the other side, yeah. When you think about a top tip for anyone out there who is perhaps contributing to this high level of credit card debt right now or has been doing too much BNPL, how they can reverse course or make sure that they're paying things off in good time to not impact them too much?
Well, I think it's important for people to realize that they have more power over their money than they think they do. And one of the ways that they can wield that power is to call their credit card issuer and ask them for a lower rate. We've done a study at LendingTree last year that showed that about 3 out of every 4 people who asked for a lower interest rate on their credit card got one, and the average reduction was about 6 percentage points. That's a really significant thing, especially when you consider how high rates are. And I talk about this in my new book, Ask Questions, Save Money, Make More. I talk about how people can just pick up the phone, call their credit card issuer, and ask them for a lower rate, and it works a whole lot more often than you might expect it would.
All right, Matt Schultz, thanks so much for joining us here on Yahoo Finance this morning. Well, coming up next, we got much more of your market action ahead as we are about halfway through earnings season. We're going to take a look at the biggest takeaways from the tech giants so far. Stay tuned.
Thus far in the earnings season, 6 of the magnificent 7 tech companies have reported their quarterly results. Apple, Alphabet, Amazon, Meta, Microsoft, and Tesla. That leaves one. AI chip giant NVIDIA won't report results until February 21st, but we gained plenty of insight into the tech sector this earnings season. Yahoo Finance's tech editor Dan Halley is here with us to tell the 2 biggest lessons we've learned so far. Hey, Dan.
Yeah, so let's start off with lesson 1. AI is still king. That's really one of the go-tos that we've been seeing. And just to run some things down with AI, Microsoft reported that they had seen a 6% revenue boost for its Azure cloud business through AI. That's up from 3% in the prior quarter and 1% in the quarter prior to that. We also saw a lot of talk from Meta about AI, how they're continuing to invest there, as well as from Alphabet, which says that they're investing more and more into their search business as far as AI goes. Amazon, they launched their new chatbot for shoppers. And then Intel and AMD were talking a lot about AI. Apple getting a little bit in there as well. Tim Cook telling us that we've got some things that we are incredibly excited about that will be showing later this year as far as AI goes. So kind of a black box for Apple so far, but that's a big deal for them to come forward and say that. And then the second lesson outside of the AI thing is that fundamentals still matter. There's no way to replace those. And so when it comes to the likes of Alphabet, yes, they talked up AI a lot, but their stock took a major hit because their fundamentals weren't sound. Their ad business suffered. They didn't meet expectations for that particular business segment, and so they fell off. The other, Apple. Yes, Tim Cook may have been talking a lot about AI, but iPhone sales in China, or sales in general in China, missed expectations, were actually down year over year. And so because of that, the stock got stung very badly. And so those are really the big lessons we're seeing so far, is that AI is still going to continue to dominate the conversation, but it's not going to take away from the fundamentals that matter the most.
Yeah, there was such a little room for any sort of disappointment in these results, and we saw that reflected in some of the movement in share prices after these results were released. Who would you say is the big winner so far? Would it have to be Meta?
It's got to be Meta. Yeah. I mean, they have the dividend, they had their buyback boosted. I mean, they beat expectations. Their ad business is doing incredibly well, especially when you look at what's going on with Alphabet, and then, I mean, today with Snap, they're just miles and miles ahead. They managed to get out from under that Apple issue that they'd seen, that app tracking transparency, which really just cut them off at the knees for a while as far as ads go. Then there was also obviously the interest rates and inflation that were hitting them there. So that really, they've done a great job from there. They also did lay off 20,000 plus people. So, column A, column B, it's going to save them money, but also that's 20,000 people without jobs. And so, they did do well there. Besides that, Microsoft.
Yeah, Microsoft certainly did impress investors there. All right, Dan, thanks so much. We still got NVIDIA in a couple weeks.
Let's let it end.
All right, let's do one more quick check of the markets here, 90 minutes into the trading day. Looking at gains for the major averages, the Dow up just about 150 points, I believe 160 points. That's all from us today. Keep it right here. Rochelle and Akiko have you for the next hour. We'll see you tomorrow.
Welcome to Yahoo Finance. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Akiko Fujita alongside Rochelle Akufo. Here's what I'm watching. Snap shares cratering after the company misses on revenue and reports slower user growth. This comes as Snap works towards making progress with its ad business performance. We're going to take a closer look if the social media platform can turn this around.
And China blue chip stocks under pressure as investors lose confidence in the government's ability to respond to an economic downturn. As Beijing takes measures to stem the capital outflows, we'll focus in on the ripple effects for investors.
And checking in on the hospitality space, Hilton delivering soft guidance but beating profit estimates for the fourth quarter. Stay tuned to hear what CEO Chris Nassetta has to say on the latest results and what's ahead for the hotel company.
Indeed, but first, let's check in on the major indices here. We're seeing still trading in a relatively narrow trading range, but to the upside at least. The Dow currently up about 150 points or 0.4%. The S&P 500, they're up 0.6%. We're seeing energy, the lagging sector at the moment. Tech, of course, one of the big gainers of the day, along with materials. And looking at the Nasdaq, that's also in the green. They're up about 100 points or 0.6% as we are still in the thick of earnings season. Let's also check in on the Treasury market as we continue to digest some of the Fed speak we're hearing this week. Looking at the 5-year, currently down about 0.5%. The 10-year, just relatively flat. They're down ever so slightly, but still sitting at 4.09. And the longest-term 30-year yield also flat as well.
We are beginning this hour, Rochelle, with those renewed concerns about a regional banking crisis. Those fears ignited by the latest headlines coming out of New York Community Bancorp. The stock extending its losses, trading down nearly 10% after Moody's downgraded the bank's credit rating to junk. The firm announcing today it would be appointing a new executive chairman, Alessandro Danello, to quiet investor concerns, but that's done little to calm the jitters. In an SEC filing, the bank stressed it had ample liquidity and did not expect the credit downgrade to have, their words, a material impact on existing contracts. And sort of, worth backing up here, Rochelle, in terms of what's been happening with this particular firm. The losses really plummeting last week when the company announced or reported higher than expected losses stemming from their real estate loans, commercial real estate to be exact. Since then, the stock has been slashed by more than half. And taking a look at where it is today, those losses continuing, really weighing on the broader regional banks. As investors try to say, is this a New York Community Bancorp specific story, or is there a potential for a contagion effect?
It's true, and it's worth noting that when you think of banks versus, say, your typical company that's trading on the stock exchange, say, if a company like Apple were to lose like 50% of its stock price value, people would say, hey, this is a great time to perhaps get on this investment. Consumers aren't going to stop buying iPhones. But when it comes to banks, it becomes about confidence because you have no way of predicting whether or not some of this news that they're hearing is going to affect whether people start withdrawing their deposits, which is why we heard the new chairman there trying to sort of shore up some confidence. And one of the other things they also did was added some provisions in for credit losses of up to $552 million. When you combine that with a cut in the dividend, it signals that there might be trouble ahead. And especially since they became a Category 4 bank after taking on Signature Bank, they crossed that threshold, which means more regulatory scrutiny, more efforts need to be made to shore up capital there, which of course is also going to cost money. And as you mentioned there, that contagion fear still not really being simmered there, even despite some of the words that we heard from Janet Yellen as well.
Yeah, and we heard from Fed Chair Jay Powell in that interview with 60 Minutes that he felt that things could be pretty contained as it relates to loans stemming from commercial real estate. But it's worth backing up, Rochelle, to talk about why we're so focused on these regional banks, the small to mid-sized banks. That's because a big chunk of those commercial real estate loans are held there specifically. Roughly $2.7 trillion in commercial real estate loans. Goldman Sachs estimating about a majority of that, 80% about 80%, by the way, is held by those smaller banks. And that's why any sign of some pressure stemming from those loans has just led to a real risk off in the space.
It's true. And Bloomberg even reporting that U.S. commercial real estate contagion now moving to Europe. So we'll continue to track that story. We're also taking a look at what's happening with Snap shares, extending those losses today, plunging over 30% on a soft full-year outlook. The social media company still reeling from a slump in digital advertising revenue. So why isn't Snap bouncing back like its larger competitor Meta? We have Jeremy Goldman, Insider Intelligence Senior Director of Client Briefings. Thank you for joining us this morning. So talk about this difference then. Why isn't Snap able to snap back in the same way as a Meta?
I think there are a lot of different reasons here, but ultimately, where to start? One of the top things here is the fact that it's a huge challenge to compete with a company that is many multiples bigger than you from an advertising revenue perspective. It's a huge challenge. Another key thing is that brand advertising dollars might be allocated a bit more to Snap than to Meta, which is driven by performance marketing. And then finally, another key thing is that I think companies are obviously cutting back from an employee headcount standpoint to invest in AI. And there's a clear signal that for Meta, people just believe more in making strategic cuts and making the right kind of investments. They believe that Meta will do that. And for Snap, the jury, seems to be out, but is not looking great.
So when you look at the latest results, Jeremy, is this the result more about strategy and leadership within the company than specific, say, on where the digital ad market is? I mean, you can make the argument, as you mentioned, about the scale that Meta has and their ability to bounce back as well. But as you noted, they've come off of a year where Mark Zuckerberg's talked about efficiency and really scaled back on costs.
Yeah, I think one thing that's really important to mention here is there are some positive signs for Snap, like taking the what investors think, putting that a bit aside, they were able to grow a number of critical metrics like average revenue per user. I think part of the challenge is that they are a bit relegated to be a niche or not necessarily afterthought, but if you're an advertiser that's looking to consolidate your spend, you're going to put it on less platforms, and you can get most of the reach that you need by putting ads on Meta, through the numerous platforms that they have, and then through everything that Google has to offer. So then the question is, what is the reason for being for Snap? Can they offer you better reach? No. Can they undercut everybody else on costs? Not really. So it is a bit of a challenge, but I think the leadership thing certainly does play into it as well.
So then, Jeremy, where can Snap win? Where do they have a competitive edge then?
I think one of the key challenges that they have, but this is where they kind of come in, is from a teen safety standpoint. Obviously, Snap it skews the youngest out of any of the platforms that we cover. And, again, like people feel better, they have positive experiences from being on the platform. It doesn't have the reach, but it might have a little bit more of a positive halo effect just from brands that increasingly care about brand safety. So again, that could be one thing that is a positive for Snap. I think another key thing is the fact that they lean into augmented reality pretty heavily. That could be an advantage. But again, this is, these are not necessarily the advantages you want. This is a little bit trying to play asymmetric warfare with companies that are a lot bigger than you.
Yeah, tough road ahead for Snap there. Jeremy Goldman, Insider Intelligence Senior Director of Client Briefings. It's good to talk to you today. Appreciate the time. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
We're watching shares of Alibaba after boosting its share buyback program by $25 billion. But the Chinese e-commerce giant did miss revenue estimates in the third quarter as it faces slow economic recovery in the region. You see the stock there under pressure, down more than 6% on the day. It's been an interesting end of the year for Alibaba here. So, I mean, we did see that pressure. Clearly, people still concerned about the broader Chinese investment environment here, because even an earnings beat, really not enough to lift investors here. And when you think about the revenue falling short, some of the pressure that it's been under, and you know, it cancelled the spin-off of its cloud computing business. So it has been under some pressure here. And clearly that buyback program, which we've seen boost other sort of companies that have been reporting this quarter, not enough to really shore up investor confidence here.
Yeah, Rochelle, on the issue of some of those business units that were broken off, one big chunk of Alibaba, the cloud computing unit, as you noted, one that investors had expected to go public, no longer. Joe Tsai, the chairman of Alibaba, kind of addressing that today, saying market conditions currently just are not in a state where we believe we can truly reflect the true intrinsic values of those businesses. So sort of kind of, just providing context on how the company is looking at this right now. Alibaba, of course, always a really good gauge of where the Chinese consumer is. And we're talking really tepid growth here. Revenue up just 5% year over year, but specifically on the e-commerce side of the things. Taobao and Tmall business, which is their main e-commerce platforms, that was up just 2% year on year. So as we try to get a better sense of where the Chinese consumer is, we're talking about some growth here, but just not the kind of growth that we've seen or we've come to expect over the last several years.
It's true. I mean, when you look at the stock last year hitting a 52-week low of $68, it does make you wonder. It did start climbing again once those stock buybacks started, sort of rumors of it started being announced before earnings season, but still under some pressure and uneven growth, as you were mentioning there.
Well, Chinese blue chip stocks have been under pressure as investors lose confidence in the government's ability to respond to an economic downturn. Bloomberg estimates the sell-off has wiped out roughly $5 trillion in value from Hong Kong and Chinese equities since the peak of 2021. Overnight, China replaced its top securities regulator, a surprise move that may signal more aggressive measures by Beijing to stem the capital outflows. To discuss the implications for investors, let's bring in Ishwar Prasad, Cornell University professor and the author of The Future of Money. We also have Anthony Sassine, senior investment strategist at Crane Shares. Anthony, I'm going to start with you. Obviously, with Crane Shares, you've got K-Web there, certainly been affected by the declines that we've seen in overall Chinese equities. As you look to see how the policy is shaping out to create a floor, if you will, on this sell-off, how do you look at the portfolio mix and what's ahead?
Thank you. Never a dull day with China. So the policy has been supportive, for the economy, especially from the fiscal side over the past 2 years. We saw that from infrastructure perspective and also manufacturing, and that helped a lot. Keeping the growth at 5%, but that hasn't been effective in actually bringing consumers back, right? So consumer sentiment continued to be depressed in China, especially after 2 years of COVID and regulations, which show some of the internet companies kind of being under the microscope and then not hiring as much as they used to. So the consumer is still, not consuming as they should. They're just buying low price tickets versus, versus high price tickets, and you can see that in the lower revenue. But these companies, K-Web companies, have done a great job over the past year of cutting the fat, right? Of cutting cost. You look at the EBITDA growth has been much better. Net income growth has been much better. Alibaba has a specific kind of situation here where they're going through restructuring. Investors still not sure of which direction, when they're going to IPO, how many different units it's going to be, who's the CEO. So these are all questions. But if you look at Pinduoduo, Kuaishou, Douyin, these companies are doing really well, growing. Pinduoduo did 94% revenue growth last. So basically within that space, some companies doing better. The overall picture is the consumer is not coming back. as fast as we wanted to. And that's because we want to see government focus on more demand side stimulus. We want them to strengthen the safety net, provide consumers with paychecks to consume, subsidize hiring, do these kind of things that kind of actually transfer economic gains from manufacturing and infrastructure to actual consumer.
So Ishwa, I want to bring you in here because as you look at some of the indicators that are showing you what's happening with the underlying economy and financial markets and the heavy lifting that the Chinese government is going to have to do, how much confidence do you think this is inspiring right now?
This is a pretty perilous time for the Chinese economy, Rochelle, because right now we are seeing deflation becoming entrenched. We see that the stock market is unraveling. The property market is not doing terribly well. Growth is slow. Employment is weak. The biggest problem, though, is the lack of private sector confidence. Households are very reluctant to consume. Private businesses are very reluctant to invest. And that's going to require a combination of things to turn matters around. It's going to require some macroeconomic stimulus, especially fiscal stimulus that more directly supports consumers. It's also going to require some measures to restore confidence of the private sector. One of the things that has really hurt confidence over the last couple of years is the management of the COVID situation, but also the fact that the government has taken a heavy hand to private sector firms in the tech sector, Alibaba being one example, but also firms in the health sector, the education sector, and so on. And during my last visit to China, there was a clear distinction between what I heard in Beijing from officials, the sense that, they were still on the side of private enterprises, and what I heard in Shanghai from many entrepreneurs, that they felt that something fundamental had changed, that Beijing was perhaps not hostile to the private sector, but was not going to support it in the way it had in the past. And that's going to mean that the Chinese government has some pretty heavy lifting in order to restore confidence, which is going to be essential in order to generate better productivity and employment growth, for which it really needs the private sector.
Ishwar, we have seen sort of the Chinese playbook in the past play out. You think about what happened in 2015. You had the national champions, the state-backed funds coming in and buying up those Chinese equities to try to create a floor on the market. The reporting out there suggests that's already begun. Given where the macro economy is right now, though, is that enough to bring the confidence back?
So right now, there is a confidence issue for both domestic investors and foreign investors. If you think about the multiple risks that investors in the Chinese equity markets face right now, there is the macro risk related to how the economy is doing and the short-term growth prospects, which look a little bleaker now than they did some time ago. Then there are the policy risks, how the government is going to respond to the slowdown, what sort of measures they will take to prop up the stock market and the property markets, and also what the long-term direction of policies will look like. And then for foreign investors, there is the additional risk of currency volatility, but also the geopolitical uncertainty and the possibility that the Chinese government might clamp down with capital controls to restrict capital outflows. Now, having said all this, as your other guest just pointed out, there are still some opportunities out there. If you have a strong stomach and think that the Chinese economy has decent medium-term growth prospects, then certainly you can find some good prospects. But it's going to take some very careful analysis to find the right opportunities in this very difficult environment, both economically as well as politically.
So Anthony, with that in mind then, what are some of the picks that you're looking at here, given that we are looking at this very uncertain, perilous time, this sort of dance that the government is doing about how much intervention it should do while still wanting some of this private and foreign investment as well?
It's a long laundry list here. Look, everything the macro is very important here to shape anything where you can invest in China. And if you look at China, there's innovation across the board, right? And we don't see inflation as an issue in China, deflation, which, and some of the negative headlines tend to overstate what's actually happening in China. So basically, it's the last 2 years because of COVID and regulations, you have low consumer sentiment, okay? That's impacting real estate and unemployment. And that's impacting demand. In turn, it's impacting private investment, which we just mentioned. So basically, the government should focus more on demand side stimulus to bring back the consumer confidence, because once that's back, and it will be very shortly, the train will go back on track. Look, China is one of the major economies with a major balance sheet, ample resources, a lot of reserves, very low debt to GDP ratio, very high savings, big consumer, so all these, they're not going away. China is going to be there for the long term, but now it's going through a cycle. And if you look at it now, it's one of the cheapest globally. It's one that has higher growth, most upside in the next 3 years compared to the US, which is more overextended. So we're looking at new sector China. Our top pick is KWeb, China Internet, because these companies were hurt the most from regulations. They are very underowned. And if you look at the activity and the flows over the last 2 weeks have been tremendous, just because seeing that the government is taking the market way more seriously now, and that's usually a sign of a bottom, right? And that could bring some momentum into these companies. Also, we like the semiconductor industry. We like the green policy industry. All these industries are aligned with government policy, right? And so these are where we would advise investor to kind of focus.
I appreciate the both of you for joining us this morning. Ishwar Prasad and Anthony Sassine, thank you both so much.
Thank you.
All right, all your markets actions still ahead. Stay tuned. You're watching Yahoo Finance.
Enphase Energy is skyrocketing after calming investor fears around inventory levels and forecasting a pickup in demand. The stock now up roughly 17.5%. But Rochelle, this is a name that has had a very choppy ride over the last year. The stock down more than 50%. So much of this is about the company and its sensitivity to interest rates. When you think about what they do, batteries as well as inverters that control solar panels. A lot of people have held back on some of those investments because of the higher rates, and the CEO for Enphase sort of making the argument that they expect the pickup to start to happen here, even outside of states like California, partly because of the more friendly rate environment.
Indeed, they did say on that post-earnings call that the CEO saying, we think Q1 could be the bottom quarter, and already seeing Europe starting to pick up as well, because they did note when you look at what they saw in terms of revenues, Q4 revenues in Europe, that was down about 70% quarter over quarter. So clearly some concern there, but they are expecting a turnaround, at least based on what they're saying on that post-earnings call here, Kiko.
Yeah, a tough 2023, sales down more than 50% from the prior year. Well, financial advisors are gearing up to gather at the Exchange Conference, where they can find building blocks for robust portfolios and industry insights. Joining us now to tap into some of those insights with key ETF themes to watch, let's bring in VettaFi Head of Research Todd Rosenbluth for our ETF report brought to you by Invesco QQQ. Todd, good to talk to you today. Walk me through some of the key themes you're looking at.
That's right. So the Exchange Conference is kicking off this weekend in Miami, Florida. We're expecting about 2,000 people will be in attendance. Most of that will be either financial advisors or other people who are looking to buy ETFs. So we geared the agenda to both help them out from an advisor standpoint and talk about ETFs. So we've got a few key themes that we've got in focus. We're going to talk about actively managed ETFs. They've been punching above their weight, and we've got new products that have come to market from T. Rowe Price and Morgan Stanley, among others. We're going to be talking about fixed income, given the interest rate environment that's likely to change with Vanguard, among others. And we're going to talk about thematic ETFs, because artificial intelligence was very popular in 2023. We'll see if it continues. We're going to talk with iShares and Invesco, among others.
So I want to dig into the thematic ETFs, because you noted artificial intelligence ETFs will be in there, but also some of these health ETFs, which there's sort of been a mixed view on sentiment around investing in those. How are you navigating that? How are you advising clients on that?
So you're right. Artificial intelligence was the stronger performer in 2023. We had ETFs like the Robo Global Artificial Intelligence ETF, THNQ, and some of its peers were up quite strongly in 2023 and have started out in 2024 to be quite positive. We are seeing that healthcare is topical with many financial advisors that want some of the benefits of diversification, but there's areas like genomics that's longer term in focus. And so Invesco has one of those ETFs that we're going to be talking about on stage at the conference.
We're getting a little more clarity. I hesitate to say that because we don't quite know how many rate cuts are in store for 2024, but at least a little more clarity from the Fed about the beginning of a rate cutting cycle. With that in mind, do you advise clients to take on a little more risk in that space, or in the face of that?
We do. We're hearing from advisors and their clients that they're more comfortable to take on some additional duration risk, as well as some additional credit risk, as opposed to hunkering down in treasuries the way they did in 2023. And we've seen that in the flows. So Vanguard's investment grade corporate bond ETF, the ticker is VCIT, has seen really strong inflows this year. Investors take on 4 or 5 years of duration through this ETF. They're getting investment grade, high quality bonds. And we expect that we're going to hear more about that at the conference. Advisors still want to get their arms around how many rate cuts are likely. The Fed has guided that it's not going to happen rate cuts until perhaps the middle of 2024. The market had been more aggressive. We know this is going to be a hot topic at the Exchange Conference.
And of course, we know about the run-up in the spot Bitcoin ETFs. We're getting a little bit more clarity on the winners and losers here. But how much of a risk appetite is there in the people that you're talking to for these Bitcoin ETFs?
So you're right. This is still early days. We're about a month into having 10 different spot Bitcoin ETFs that came to market, as well as the Grayscale GBTC ETF that converted into an ETF. We've seen a couple of firms rise to the top, in particular, BlackRock's ETF, IBIT, and Fidelity's ETF. We are also seeing some other firms have success. So Bitwise, BITB, has been one of the more popular ETFs, and they're going to be on stage talking to one of my colleagues at the exchange conference about educating towards Bitcoin. This is still very early days. To your question, we're seeing advisors interested in having 1 to 3% of their portfolio dedicated to their cryptocurrency, but they want to get off of zero. And if they want to get off of zero, then they need to understand what the drivers are of cryptocurrency and understand the differences between some of the products that are out there.
Indeed, certainly going to be a key theme that I know I'll be keeping a track of. Todd Rosenbluth, thank you as always for joining us.
Thank you.
Well, if you're doing your taxes and wondering why you are paying so much, specifically in state taxes, well, you're not alone. Many Americans are making the move to no income tax states in 2023 to save that money. So here with the details on that is Yahoo Finance's Rebecca Chen. So Rebecca, talk about the move to some of these no income states and perhaps some of the downside that people should also be aware of that comes with this.
Well, there's some downsides, but I just kind of want to point out that in 2023, the official stats are in Americans love moving to Florida and Texas. These are the two states with the most domestic immigration, according to the U.S. Bureau. And Texas added nearly 500,000 new residents in just 2023, and Florida added nearly 400,000. And these are big numbers. And on the flip side, we can see that states like New York and California actually lost most residents in 2023. And, when we compare the characteristics of these states, you can see that Florida, Texas are no income states, whereas New York and California are states with some of the highest income tax rates in the nation. So there is definitely a trend of people moving to these where they can pay a little bit less taxes. So when we were doing, when we were doing our report,
go ahead.
When we were doing our reporting, we wanted to figure out just the actual number of how much you actually can save from when you move to, say, from California to Texas. And what we found is if you make the median salary in California, which is about $92,000, you actually, right off the bat, to a no income state, you save around $3,000 to $5,000 in 1 year without just doing anything, just because once you pay your federal taxes, you're done. That's it. No more state income taxes for you. And of course, this goes to show that the more you make, the more you actually save when you make that move. So we do know that California is a progressive tax system, so the rate goes as high as 13.3%, and this is just on top of the federal taxes you pay.
Rebecca, what are some other cost of living factors that taxpayers should account for?
So there is one big thing that we also wanted to look at. Let's say if you're not paying state income taxes, what are you actually paying? Because states, they have to generate their revenue from somewhere. And that somewhere is usually property taxes. And what we have seen is that the average U.S. homeowners pay about 0.99, almost 1% of property taxes in their state. But in a state like California, you're actually only paying 0.71. So it almost balances itself out. You're paying more in income taxes, but the lower in property tax. And going back to the previous sample I've used, in Texas, you're actually paying 1.6% on your home value. So Texas homeowners are nearly paying more than double of what California homeowners are making. And of course, the argument is then California homes are so much more expensive. That is true. But once you buy a home in California, you're paying taxes on the appraised value that is limited in growth every year. So in a way, just before you go to a different state, you got to watch what you're paying, not just what you're paying in income taxes, but also if you do end up buying a house, what you are paying in the property taxes and how that can mark up in value every year, because that could just wipe out all of your saving if you're not careful.
A lot of factors to consider there. Rebecca Chen, as always, thanks so much. All your markets action ahead. Stay tuned. You're watching Yahoo Finance. We are just days out from Las Vegas hosting its very first Super Bowl. The big game is the latest in a string of sports wins for the city as the legalization of sports betting makes the city an increasingly attractive destination for leagues. But the city's mayor, Carolyn Goodman, says it wasn't always that way. I spoke to her about the long road it took her and her husband, the previous mayor, to get here.
My husband actually made a list of all the commissioners of every major league sports and went out about the country to go visit these commissioners to talk about coming to Las Vegas. Of course, it fell on deaf ears, but it didn't stop us. And we had the summer league with David Stern from the NBA here, and things began to develop, and we established good personal relationships. And then in the 2003 Super Bowl, the city made an effort to advertise because we have a great city, lots of hotel rooms, great entertainment. And of course, we were turned down. Why? Because Nevada was not the best place to be advertising, it had legalized gambling. Well, lo and behold, every city, almost every state in the country is always looking for ways to fund their many, many projects. And it became more and more challenging. And in 2018, the Supreme Court said, bingo, open up sports betting, anybody, legal sports betting. And of course, here we were for years, decades, having everything in place to monitor it and make sure how we do it. But therefore, it became okay. And so the Major League Sports pursuit continued. It's so exciting for us here in Las Vegas to have this wonderful event coming here now, right now.
How much of an economic boom or economic bump are you likely to get from the Super Bowl, as in the city of Las Vegas? To what extent does that trickle down to the residents that live there?
Well, I think, first of all, the excitement here is palpable, certainly because we have now enlarged our airport to bring in direct flights from around the world. Everybody knows the name Las Vegas, even if you don't speak English. You hear it, heads turn, they're excited. It seems to be a place where so much is going on. They've got great dining experiences, shopping, great weather normally, as I said, an ability to have conventions and meetings and just everything so tight, and yet so many opportunities for personal sports, be it golf or tennis. Red Rock is internationally known for its great rock climbing. Of course, we have dwindling Lake Mead, which we're holding on to for all the boating events that you want to do. And it's just a place where 24/7, everything's open. And that is like no other city in the country. Everybody closes down while we go into a new shift.
I counted 4 sports teams, professional sports team you've got in place in Las Vegas so far, including the WNBA. You've got another team moving in, the Oakland A's, soon to be the Las Vegas A's. How do you build on this vision?
You continue on. We've been trying for the MLS, soccer, through Commissioner Garber now for my full term. We were pretty close as they seek to expand and bring in new franchises. I am convinced it's just a question of when that Adam Silver will say, yep, we love Vegas. I mean, it just continues because of the hospitality and our pride in how we do proceed to build a base for people to come in, relax, have a good time, stop your worries, and come in here or pursue investing in our wonderful community, because unlike, as you would well know, so many other states, we have no state income tax, no business tax, no estate tax. And we have so many opportunities where one can find funds to build and develop. So it's just, it's so exciting. I hate to sleep. What's coming next?
Mayor, let's talk about the broader economy. Nevada, the state of Nevada, has the highest unemployment rate in the country. At last check, the rate is well above 5% in Las Vegas as well, compared to 3.7% unemployment nationally. How much of this is a COVID hang-up? Why do you think it's been so difficult?
The fastest recovery out of COVID was right here in the heart of the city, not in the county, in the city. We were the #1 recovering place. Now, a lot of it for us in the heart of the city has to do with a lot of small business. It also had to do with the fact that our governor during COVID shut the Strip down. So when you go ahead and also close the schools, that's where the impact was. But all of our people, we have a lot of unskilled but very necessary jobs to take care of our hospitality corridor. And when the governor closed down our community, that put down the enormity of our hospitality workers.
Yeah, I mean, when you think about the trajectory of where the economy is headed, are you confident you can get back to some of those pre-pandemic levels? You sort of, Las Vegas really came to a halt. The economy, the impact was pretty significant. The services sector right at the heart of it.
The whole thought of this is our entire economy, 100% of the people that come here want to be part of this vitality, and the hospitality corridor of the Strip, even though we're diversifying our economy, it is more than just the Strip, and we could talk about technology and so many other things, our medical district, what we're doing there, the cultural base. These are all employment pockets, but it was the Strip, and that is what closed down. And so the recovery, it is almost back. We're almost up to the tourist visitation.
Finally, Mayor, if I can bring the conversation back to sports, because that's where we started, and sports betting, which has really led to a big boom in the Vegas economy. Have you placed a bet on the big game?
My husband will bet on cockroaches racing across the floor. We have one person that bets in the family. Well, to my knowledge, there's 6 members of the family, but one, and he loves it. And we have more prop bets than you can imagine. Interestingly enough, no prop bets are being taken on whether Taylor Swift makes it or doesn't make it, and how many times the camera's going to focus on her. So it is, you're absolutely right. And our downtown, our sports books here are just having the best of times. And of course, we have all these wonderful hotel rooms that shows that Las Vegas does a lot of winning and what it bets on.
Mayor Goodman, really appreciate the time today. Thanks so much for joining us.
Thank you so much for having us.
Las Vegas Mayor Carolyn Goodman there talking to me ahead of the big game. Rochelle, officials in Vegas expecting roughly 330,000 visitors for the big game, expected to generate roughly $600 million in revenue. But there's an interesting intersection that Vegas is now hitting on, something that UNLV has called the fun economy. We're talking about sports, entertainment, and then tourism. And that's why they're able to attract a lot of these sporting events now.
I mean, when you look at that, $13.7 trillion for the fun economy, that's equivalent to about 14% of the global economy. And to put that in perspective of other industries, an estimated 9 times the size of Big Pharma and nearly 5 times the size of the global automotive industry. And you raise a good point about it really being this intersection in a way that we haven't seen before. I mean, Vegas, Nevada, it has the weather, it has, a lot of conferences that come. But then when you factor in sports and performances, the Super Bowl, this very global stage for Vegas in the spotlight. And something else that I'm looking at, there's a project, a $10 billion project, which is going to expand their sports, including an NBA arena, a hotel, a resort, but a high-speed rail system connecting it to the city of Los Angeles. So then you sort of broaden it out to that sort of access as well. And that's supposed to be due in 2028. Vegas is really setting itself up very well here.
Yeah, but sports betting really got the ball rolling there. So certainly a lot of leagues looking at that as a destination now. Well, coming up, a deeper dive into Hilton's earnings report. Yahoo Finance's very own Brad Smith is going to dive into the company's quarterly results with CEO Chris Nassetta on the other side of the break. We'll be right back.
A check-in on the hospitality space as Hilton beat profit estimates for the fourth quarter, delivered some softer 2024 guidance compared to what analysts were expecting. Higher expenses in the tape there, signs of slowing demand for leisure travel, at least compared to international when you comp U.S. versus international in the outlook there. Hilton CEO and President Chris Nassetta joins us now on the company's quarterly results. Chris, great to have you here with us to really dive further in on these numbers and some of the trends that you're seeing get locked in right now. We're finally eclipsing some of those pre-pandemic markers. How much of that do you still think is part of this larger trend, and can the company still capitalize on?
I think so. Thanks for having me on, Brad. Listen, last year we finished the year in a really strong way. We ended up for last year having the highest earnings that we've ever had, the highest margins that we've ever had. We beat fourth quarter expectations, as you know, handily on top and bottom line. And we had a huge amount of momentum on the development side, signing more deals, 130,000 rooms last year than we ever have, opening more rooms in the fourth quarter than we ever have in our 100+ year history. And so we carry a lot of momentum into this year, both on same-store growth, which I'll talk about, and on unit growth, which is increasing at a good pace, coming off the momentum of last year. What we're seeing in the business in terms of the different segments of travel is actually quite good. What's going on is business transient, which is the biggest segment of our business, continues to strengthen. It strengthened in the fourth quarter over third quarter numbers. We expect this year a continuance of that, so that it'll continue to get better, both in volume and in price. The meetings and events business, which is a decent size, 20% of our business or so, the demand, because there's so much pent-up demand, is really off the hook strong. I mean, our group booking pace for the year is up 16%. And so there's just demand. There aren't enough places for people to meet because you went through a generation of hotels that were built without a lot of meeting space being built. And so great demand there. And even leisure, which obviously, was, sort of stratospheric coming out of COVID, is continuing to grow. I mean, it is not going backwards. There's still a lot of demand, and the pricing power is quite good. So we think all our segments are going to show growth this year, and in demand and in pricing, because here's the other side of the equation. In terms of the laws of economics, there isn't a lot of supply coming in. I mean, our 30-year average of supply in our industry is about 2.5%. And this year, last year, and for the next couple of years, we'll probably deliver as an industry, 1% or less. And so the setup is really good for the year, which you can see is reflected, in the market's reaction today.
Right. Yeah, as you think about the next couple of years, I can't help but to look at the amount of rooms that you have that are in development and in this pipeline right now. 462,000 rooms in development pipeline, over the half of them under construction. You were mentioning on the earnings call, I caught a whiff of it after I got off our 9 to 11 show this morning. One of the huge things, though, that some analysts might be keying in on is what interest rates do for construction and how that impacts the delivery and bringing online fully of some of that pipeline. How do you kind of view it from your standpoint?
Yeah, well, the good news is you're right. We have the highest level of pipeline we've ever had at over 462,000 rooms, over or around half of which is under construction. So if it's under construction, it's already been financed. And so what we're seeing as an industry is very low supply in terms of new hotels. What we're seeing as a company, because our brands are the strongest performers in the industry, is we're getting a disproportionate share of the things that are getting done. And so we actually saw our starts in the world and in the US move up last year, even in an environment where financing is still reasonably difficult to get and interest rates are higher. And we expect that to continue. We're certainly seeing that in the first quarter. The answer to why is, listen, our brands are really high-performing brands. They're the most financeable brands. And while there's less money than there might have been 4 or 5 years ago for new development. There is some money, and the economics in the underlying business broadly are good. And then for us, given the ability to drive higher levels of market share and revenues for our owner community are even better. And so people are very anxious to get projects underway, and those that can get financed are doing so. And we expect them to do so at an increasing rate. Yeah. I do think there'll be more money broadly available this year for financing new construction. Interest rates are actually down. They probably have more to come, but interest rates are down in terms of the borrowing costs for our borrowers off their peak. And at the same time, you know, we're doing more as a percentage of our overall growth in conversions. So existing hotels that don't really require financing. I mean, last year, 30% of our unit growth was conversions of existing hotels. This year, it's going to be 35% or more.
And so Chris, just lastly, and I have to hustle to my finish here, but when you think about that capacity, reporting out recently this week and a question on the earnings call that Hilton is at least kicking the tires or potentially evaluating a potential acquisition of graduate hotels. I don't know if you'll speak directly to that, but what is the determining factor on an acquisition in this environment versus a strategic partnership like you announced with SLH?
Yeah, well, I've been consistent, if nothing else. Of course, I'm not going to talk about anything that's sort of speculated and rumored in the market, but I've been saying for the 16, almost 17 years I've been running this company, all of which, by the way, throughout all of it, we have not bought anything. We've done all of our growth through organic brand development. So we had 9 brands when I got here. We have 22 brands today. But but I've always said consistently that never say never. We look at everything that's available in the market. We always have, and it has to pass through a very rigorous filtration system of being something that we think is really accretive from the standpoint of our brand portfolio and an offering to our customers, and accretive to the value of the company. So for the last 16 years, nothing has passed through that filter. Thus, we've bought nothing. Right now, there's a lot of, as you pointed out, interest rates are higher. There has been a lot more stress in the environment. And so there's probably a little bit more opportunity, not for, elephant hunting, but for smaller tuck-in opportunities that because of the environment are stressed for us to consider things that might get through the filter. And so we've always looked at it we've always looked at everything. I think it's just a little bit more opportunity than we've seen. We haven't done it other than a partnership, which was not an acquisition with SLH. And if and when we do, you guys will be the first to know. But but it's a more interesting environment.
All right. Well, we would love the opportunity to help break that news with you. Chris Nassetta, Hilton CEO, thanks so much for taking the time here today. Appreciate it.
Thank you, Brad. Great being with you.
Good to see you. IXIC, I'll toss it back over to you.
All right. Thanks so much for that conversation, Brad. That does it for Rochelle and I in this 11 a.m. Eastern hour. Much more to come here on Yahoo Finance, including Disney earnings after the bell. Keep it right here.